I check if Good morning, ladies and gentlemen. A very warm welcome to FSM1.com's flagship event, What and Where to Invest 2021. This year, at What and Where to Invest 2021, FSM1.com intends to put together your investment survival kit to ensure that you survive and thrive in your investing in 2021 and beyond. We have a lineup of online presentations today, as well as on the 12th, 14th, 19th, 21st, and 26th of January in the evenings from 7 p.m. to 9 p.m. Over this series of presentations, we'll cover various topics to put together for you a suite of survival kit items and the respective tools that will be helpful to you as an investor as you navigate new market conditions in the coming year. Today, you can look forward to presentations by Colin Lowe, Senior Macro Research Analyst at IFAS Singapore, as he shares their investment outlook for 2021. A special presentation on China from Will Shum, our Director of Portfolio Management and Research at IFAS Hong Kong. A look at what's next for the Singapore market, as well as a special presentation featuring Catherine Wood on investing in disruptive innovation via the Nikko AM ARC Disruptive Innovation Fund. In addition, today is the start of the opportunity for you to earn chances towards our lucky draw. So be sure to join us each day to earn chances to help you win in the lucky draw. Accumulate chances throughout the event for the draw happening on the 21st of January, where the winner stands a chance to win up to $1,000 worth of FSM1 Auto Sweep account credits. To be eligible, head to the event line live via the link in the confirmation email you received when you registered for the event. Remember to use the same name or nickname and email address in order to accumulate the chances. Get one chance per day by logging on each event day from the 9th to the 21st of January 2021. You can also get one chance per day by participating in the daily quiz sessions. Or you can also get one chance per day by completing and submitting the survey on the 21st of January 2021. You can also get one chance by visiting our partners pages. They are Nikko AM, Schroders, UOB AM, and Allianz. Lastly, you can also get your one chance by sharing this event on your social media through the social media buttons on the footer. Remember to access Event Live using the same name or nickname and email address each day so that you can accumulate as many chances as possible. Each day, you can also take part in a daily quiz where we will be giving away $100 worth of FSM1 multi-currency cash account credits to 3 lucky winners during the sessions on the 9th, 12th, 14th, 19th, and 21st of January. If you were wondering what this 3D torchlight and compass represents, it is a key item in one's survival kit and also outlines the theme for today's presentations. Let FSM1.com shine a light on the areas of opportunity and point you in the right direction of where to invest in 2021. As we gear up for the start of the sessions today, you'll note that we have opened up a poll for today. So do interact with us and the various people watching in sharing your experience and opinions in the polls. We're going to open up a poll early this morning as we begin our first session. To participate in the poll, firstly, click on Event Activities on the menu below this video. Under the agenda, look for the poll schedule, then click on the Join Poll button. The poll window will be displayed to your right. Okay, let's start with the very first poll question. By the end of 2020, was your portfolio in the red or green? 2020 wasn't an easy year for us all. So let's cast your votes. Was it in the red or green? Oh, I'm happy to see that majority of us voted for green. But for today's event, we will work towards getting better with that. Now let's move on to question 2. What was your biggest investment mistake in 2020? Did you miss out on market lows? Did you sell too early during the rally? Bought high, sold low? Were you too afraid to invest? Or did you make some wrong calls on sectors or companies? Let's cast our votes. Oh, 50% of us missed out on market lows. Okay. Question 3, what market do you think will be the most likely to outperform in 2021? Is it emerging markets, Asia, China, Singapore, US, Europe, or others? I think we all have an idea which one we're thinking of. And we'll see that in a bit. And here we go, 50% of us chose China, followed by 18% of us picking the US, then emerging markets, and 12% of us picking Asia, and 3% voted for Singapore. Question 4, technology or disruptive innovation to sell or add exposure? Or are you unsure? Remember, this poll is anonymous, so we wouldn't know who voted for what, so cast your votes. Most of us want to. That's great, and 7% of us are unsure. It's okay. We'll discuss a lot more today to give you a better idea. And the final question, with technology, which are you most bullish on? Is it China tech, US tech, or global tech? With that, let's kick off today's session with a panel discussion. Looking back, the lessons learned in 2020 and how we can help you in 2021. 2020 was a watershed year in terms of the upheaval it has brought to our lives. Our investment portfolios have surely been impacted too from the COVID-19 and economic disruptions. So in this panel, we'll be hearing from various investment speakers on the lessons learned in 2020 and, more importantly, the investment ideas and strategies to better position our portfolios in 2021. So joining us today on the panel are Darius Fu, Head of Intermediary Business Development, Nikko Asset Management; Kenneth Lowe, Co-founder and CEO of Sidley; David Kuo, co-founder, The Smart Investor; and Yo Wei Ren, manager, stocks and ETFs research, IFA Singapore. Moderating this session will be Mr. Jean-Paul Wong, General Manager, FSM1.com, Singapore.
Thank you, Geraldine, and thank you to everyone who has joined us this morning for FSM1's What and Where to Invest 2021. We're very happy to have you join us in this virtual investment conference. We hope that you'll take a lot of interesting insights and hopefully good lessons in terms of how you're planning for your investments for this brand new year. So in my panel, I'm also very pleased to have the various participants that Geraldine has introduced just now. I'm sure that they have their own ideas, and I'm sure that there will be an interesting discussion in terms of the main topics that we'll be going through today. So we'll start off with the main theme for this panel discussion. So a review of the lessons learned in 2020 and what a year it was last year with the pandemic and the decline in the markets and the subsequent very rapid rebound that has continued in various asset classes even till now. And in terms of the lessons learned, how will these actually help you in terms of 2021 investing? So I'll start off with this main question. What was the one main lesson you take away from 2020 in terms of how you plan your investing? So I'll turn to Darius first in terms of how you looked at it last year.
Right. Thanks, JP. So I guess, the year has been very, very challenging, and the key lessons that I've kind of learned personally in my own investment journey is that what really goes up can come down very suddenly. And if you are kind of like sitting more on the speculative fence, kind of riding the trends and all, trying to pick the falls, it was an incredibly exciting time. But I do think that, there's some room in our portfolio for such allocations. And the one key lesson I guess I can take away is that as investors, we do need to make sure the bulk of our assets is in something secure, and then look for that tactical opportunities, within the realms of other things that's sensible. Yeah.
And Kenneth, I'll turn to you because you have a community of investors. So what was one main thing that you kept hearing from them in 2020, and what was your advice on that point?
Yes. So I think 2020 was a super exciting year for a lot of new investors, beginner investors, because I think there was a lot of chatter on the ground. There was a lot of discussions around getting started, and I'm sure you guys saw record sign-ups in brokerage openings as well. So I think likewise across the industry, a lot of new investors were going to the market. A lot of them were making their first stock purchase during the March-April period. So I think we will see what happens, but I think overall it's a very exciting time for the investment scene as a whole in Singapore.
And David, was it a similar kind of response that you heard from your investors over last year in terms of their fears and concerns and opportunities?
Pretty much so. I think a lot of people out there were saying, are we all going to die? And then the next question was, what am I going to do with my portfolio? Well, if you're going to die, why worry about your portfolio? So I think people like to worry about something. And all the news that we saw in coming through not only social media, but also mainstream as well, got people very, very concerned. And I think the key takeaway really is to just keep calm and carry on investing, because we all like to worry about something, and the market loves to worry about big things. And if you just ignore all of that, I think it would have been okay in 2020.
I think so as well, in terms of staying calm amidst all the challenges we faced. So Weiren, as the research manager at iFAST, how was last year in terms of the main lesson you took away?
I think the key lesson that I took away from 2020 was really the confirmation that the best buying opportunities in the markets are usually in times of market crisis. I think Warren Buffett has always said that you should always buy when all the other investors are fearful. We don't have that many opportunities to put that into practice, but earlier this year, 2020, I thought it was the perfect opportunity for us to put that into practice. So I think this is a timeless piece of advice that has worked, not just in the past, but in 2020, I think it has worked well. So if you have loaded up on stocks during that sell-off earlier this year, I think your portfolio would have done exceptionally well. So I think market crisis really the best time for us to invest and add risk to our portfolios.
So I'll move on to, I think, in terms of the sectors that have performed well in 2020. So I think in 2020, one of the main things that we saw in the markets was the huge, big performances coming from the digital innovation and disruptive innovation sectors. So in terms of the K-shaped recovery that some investors are talking about, which is basically an unequal recovery across sectors amidst the pandemic. So we saw digital innovation coming out strong. So I think on this question, there's a couple of people in the panel especially who have something very close to this team. So perhaps I'll just turn to Darius first. Sure. Darius, with the Nico Ark Disruptive Innovation Fund especially in mind, what should investors do going into this new year? Should they be, let's say, adding to their positions? Should they be, trimming some of it because of, that huge pickup that we saw? Or should they just be selling it altogether?
Thanks, JB. I think that's a million-dollar question, and kind of adding on to what David shared earlier, when everyone's asking, are we going to die, right? The next thing is, what are we going to buy? What are we going to invest? And truly, I mean, the disruptive innovation space has done incredibly well. You see the performance, and I don't want to give away too much, now, because I'm going to do a session later in the afternoon. So I'll go into a bit more details there. But I do think that, there is still a lot of opportunities that, investors have not accounted for. So while your question alludes to what has helped in the recovery of the tech space. It's very intuitive to say, oh, it's the technologies, it's things like the Zoom, so on and so forth. But I think what a lot of people, during the 2020 investing period, they've jumped on that bandwagon, but they don't realize that there's actually quite a fair bit of knock-on impacts into other industries as well. So even just with conferencing as an example, a lot of people were jumping on the bandwagon because that's how businesses would operate. But there is a particular holding, since you mentioned the Disruptive Innovation Fund, and it's called Teladoc. So Teladoc is, for lack of better description, is a pharmaceutical company. And, in the US, unlike Singapore, where we see the doctors and we get medicine straight away on the spot, in the US, you get a prescription, you go out to the pharmaceutical companies and buy that. Now, Teladoc has, kind of reported that previously, before COVID-19, they had about a 10% user rate of people buying medicine online. But during this entire pandemic, that shot up to about 40%. And I think that's where, companies such as Teladoc has made quite a fair bit of headways during 2020. And this is something that we are monitoring very closely, because this has also impacts in terms of your lifestyle, change. So these 40% of people very unlikely will go back to queuing at the pharmaceutical lines to buy the medicine anymore. And this is a direct impact of, technology at play, or the COVID-19 knock-on effects, we like to call it. So again, if we're, just to round back to your question, JP, if we're looking for, applications, one would say don't just look purely at the tech aspect of it or the most obvious names. You need to start going down the value chain to ask what will be impacted and, what will sort of take off from there as well.
Yeah. Yeah, thanks, Darius. I think, in one of the polls that our audience has participated in, a wide majority of them actually say, let's add to this technology and disruptive innovation team for this year. So maybe I'll just bring Wei Ren in, because there was a point early last year when you and the research team were discussing this team and how to perhaps recognize its importance in our portfolio and bring it inside the portfolio as a core component of the portfolio. Can you share with us and the audience a little bit about that thinking going into this year as well?
We think the technology, we think that our portfolios, the makeup of our portfolios should always reflect the reality of our global economy. And the reality right now is that the global economy is increasingly undergoing digitalization. So for consumers, our daily lives are being digitalized. I think for businesses as well, I think technology is no longer something that is considered a luxury. I think it is something that is essential to their operations. So we think that technology is, it's everywhere. And I think like what Darius said just now, in healthcare as well, that is also something that's being disrupted. In finance, you've got fintech as well. So everything revolves around technology. And it is our belief that the makeup of our portfolios should reflect this reality, which is why we thought that, for all investors, whether or not the tech sector is expensive or cheap, you should always have some form of exposure to the tech sector, because this is something that is increasingly important to the global economy, and it's also indispensable part of our everyday lives.
I think the point about the run-up in the digital tech sector has also led to a question, I think, in some of our investors' minds about what's the right value to pay for such a sector, and which then links up to my next point about value investing. I mean, has that gone out of fashion altogether? Maybe I should ask that to David. Traditionally, I think it's one of the strategies in terms of looking for value plays. That's something that I think you look into as well. So how should we look at value investing?
Well, anybody who says that value investing is dead suffers from a lack of patience.
Yep.
And my advice to those people is learn to play chess and play the long game. Because ultimately, when you are a value investor, you are looking for stocks in the market which you believe have been put to one side by the market and are currently waiting for its value to be outed. Now, if you're waiting for the value to be outed, it can be outed in a number of ways. And the outing of that value doesn't come just after you've bought it. It could come many days, many months, many years after you bought it. So you have to find the right value share. And if you find the right value share, one that is actually paying you a dividend whilst you are waiting, then you can afford to wait for a very long time. And so I don't think value investing is dead. I think there are lots of shares out there that have been waiting for value to be outed. And if you are patient, then you will be rewarded at some point. So adopt that Warren Buffett approach. Just be patient.
I think it's a good point. I think if we look at also the fact that there could be a rotation play going on in the markets, just going back to David, what would then be a sector that is showing great value to enter at this point?
Great value. I think that there was great value a couple of months ago in the banking sector. If you had a look at the banks, that was when I was telling people, go and have a look at the banks. They are ridiculously cheap. They're trading at well below their price to book. They are still paying a dividend, and they are still doing okay. So why aren't you buying the banks? So if you had bought banks a couple of months ago, now you would be sitting on a pretty substantial gain. But I think there is still value in the banks. I don't think the banks are done yet, especially as we come out of recession. I think that is what is going to be outing the value of the banks. People will suddenly realize that we are coming out of recession, and banks are always at the forefront of the economy. So they get hit when we go into recession, but they're also one of the quickest to recover as we come out of recession. So in answer to your question, I would say banks, and also look at insurance companies. I think they would be a good value play at the moment.
Yeah. I agree with you, David. I think having a bit more exposure into the financial services sector, just on a simple global basis for a start, is something that I've also done. I've added to that position as well earlier this year. So I'll go to Kenneth. In your community of investors, especially a lot of investors there, right? Was there some sector that they keep talking about, and you felt that perhaps that it's a bit overhyped? How do you enter into that chatter and try to give your perspectives?
Yeah, I mean the obvious one is in the tech space, right? Because naturally everyone online is very sort of attuned to technology. Because if you're on social media, you understand what Facebook is, you understand Instagram, and of course recently Tesla as well, right? So I think that's the big one that everyone's talking about with its recent run-up, and I think becoming one of the more valuable companies in the world. Very interesting space, but there's a lot of noise. So you got to figure out what's really a signal for you to sort of take back as well. I think one underlooked area is actually in the travel space, and I think the return of travel, because I think it's going to come in maybe 3-4 years, depending on what the industry is saying. But I think it will come back because nothing can quite replace it. Earlier in 2020, there was this Airbnb experiences. I'm not sure if you guys tried it. You go online, there's a virtual tour. They bring you somewhere in Europe, and then you walk around. So I think that was interesting, but it didn't really quite replace the actual feeling of being there. So I do think that that's something that I'm personally looking at as well, and how that will play out in my portfolio.
It's something that I think a lot of us are looking forward to, back to traveling, one of our favorite pastimes here. So maybe I'll just talk about the rotation play a little bit further. I think financial is one of the sectors that where we find that perhaps it's good value, hasn't really been recognized perhaps fully, even till now. How about Darius, in terms of value plays, are there any off the top of your head at this point?
Right. I guess one very under talked about area as well in 2020 was the fact that nobody is buying retail anymore. Right, and the curiosity, obviously, we see how, as what Wei Ren said, technology, online and everything has kind of replaced certain physical aspects of it. And I totally agree with what Kenneth said, like certain things like travel cannot be replaced by an online experience. But I do feel that the retailers, like it or not, say in Singapore, we obviously have the painful experience of seeing Robinson close down. And across the United States, you see many, many other retailers suffering. But one interesting thing about most major brands in that sense, right, is they never really fully go away. Right, so there will be consolidations in the industry. You will see other brands buying up other brands, and so end of the day, it's kind of a place where, as the players consolidate, you just got to find where the potential winner is going to be. Now, of course, taking all things into consideration, it's always going to be tough because retail is still kind of brick and mortar kind of a business. But we've done some work around that, and we noticed that some of them have progressed a little bit better. Like again, what Wei Ren said, on the online spectrum, and it's really now trying to understand where they are making that profit margins, and can they still keep that lucrative, kind of revenue that they were making before, and all without the need to share, with actual distributors, wholesalers, so on and so forth. So I think that's an area that, maybe borrowing what David said as well, not many people have the patience to do the work and to understand where that industry is going. But, again, if you start to look at it, and I have a common joke, right? And I always say, Milo is going to outlive all of us as a generation, right? So if we're looking at stuff that's going to be here for a while, then borrowing what my fellow panelists have said, your horizon should not be what's happening next month or 1 year down the road. It's really what's going down 3-5 years down the road. Yeah.
Yeah, thanks, Darius, for that. And I'll go back to Wei Ren, because I think in your team's research methodology, you use valuation metrics as one of the key factors in terms of where to find the next big opportunities. You also look at equity markets earnings growth in the next 1 to 2 years to estimate whether some of these markets and sectors will be making more money. So can you just maybe quickly recap maybe the main idea, the main opportunity based on these metrics for this year? Which one is attractive?
Based on sectors?
Yes.
For us, I think in terms of sectors, I think like what David has mentioned, I think I do agree that financials is one area where we feel that investors should really be concentrating their attention on for this year. I think it's also one of the few sectors that really still offer some sort of value for investors. And the reason for that is because, if you look at the banks, for 2020, their earnings have been smashed really hard because of the loan loss provisions. But in 2021, we actually expect that to actually go down, and that also means a turnaround in the bottom line for some of the banks. And also, I think another major catalyst for the banking sector is a resumption in dividends and share buybacks. So when that happens, when that eventually happens, then of course, I think investors are going to go back into the banking sector again. Insurance, on the other hand, I think is also affected by COVID because because of the social distancing measures, it limited the interactions between the insurance agents as well as their clients. And I think insurance for me is something that's exciting because it's one of the industries that benefits from an aging population. And I think with major markets like China, US, experiencing an aging population, I think the industry, the insurance industry is also another exciting sector that we're looking at as well. So I think if there is a year for financials to do well, then I think 2021 will definitely be the year.
Yeah, thanks, Wei Ren. I think among the rotation play ideas that we've talked about, financials features quite a bit. Of course, there could be other sectors like your industrials as well, could be quite interesting, or even some of your emerging markets could start to perform in an interesting manner going into this year. We talked mostly about equities, so we'll try to talk about fixed income a little bit later, but I'll just go back to this point that Wei Ren was talking about US-China, so that brings me to my next theme. US-China friction, we can't run away from these two economies, the two largest in the world. Lots of talks about China overtaking the US in a number of years. Some are saying perhaps by 2024, others are saying by 2025. So it seems almost like it's a talk about when that will happen rather than if. So maybe we'll just start with some of the issues at play that we've seen for these two economies in the last few quarters, the last 4 years during the Trump administration, which will now come to its end quite soon. So the tick for tack, trade tariffs, trade wars, and the uncertainty on some of the Chinese tech sectors, especially because of the US measures. So how is that going to change with the new Biden administration? I'll ask David perhaps to look into this question.
Okay, well, I think we have to remember at the outset that this is not just about trade. I mean, this is ultimately about an ideology. The US and China have very, very different ideologies about how to run an economy. In the case of America, it is very much in favor of capitalism, whereas in China you have this thing called socialism with Chinese characteristics. That's just another word for Marxism, right? And so because you have this big difference in ideology, you will never be able to see the two economies, the two countries come together and agree that theirs is the right way, because capitalism and Marxism or Leninism will never mix. And I think this will continue for a long time. So it's not just about tech, it's not just about telecom companies, it's not just about trade, it's about ideology. And how how do you try and rationalize these two? It will never happen, John Paul. It will never happen. So therefore, I think this will carry on for a long time, probably long after I am on this planet.
Yeah, I think yes, it's the ideologies differences, and that probably will set the stage for continued differences in opinions between the administrations on the U.S. side and China. And perhaps it is a little bit difficult, I guess, for any new U.S. administration to turn back on all these measures that have been taken by the Trump administration, whether it's because of ideology or the political cost of it as well. So maybe I'll just turn to Kenneth here, because I think you mentioned as well about some investors, or at least there's been a lot of investors investing more into Chinese tech stocks, whether it's listed on the US or let's say on Hong Kong, and perhaps increasingly so there will be more of that shift because of all the problems that some of these Chinese tech stocks are facing in the US, right? So from your investors and for yourself, how do you look at this opportunity in the Chinese tech sector? And I think in one of your recent posts, you talked about the disappearance or the mysterious one of Mr. Jack.
Yes.
So how do you tackle this topic?
Yep. So, Mr. Jack, if you're watching, please show up soon. I think the situation is quite interesting, right? So there's a lot of community chatter about the disappearance of Jack Ma himself, but I think a lot of people also tend to forget that he actually handed over the reins in a very good fashion to Daniel Zhang in 2015. So he's also been thinking about the 100-year company that he's trying to build, not just a 20, 30-year company. So I think that's part one. I think the second thing is also about the fundamentals of the business. If people look at Alibaba as a company, it's definitely a very strong business. It's got its hands in different pots and industries as well, like cloud computing. There's of course e-commerce, which is its main cash cow. So I think as a business, it's very interesting, and there's a lot of market sentiment that's driving the price downwards. So community is generally thinking that it's a very interesting opportunity to buy into that space. But of course, there's a whole political risk, which I think no one really understands how that will play out, because it's not yet on the list. They're saying that it will get onto the Trump administration list of investment ban stocks. So I think that's still waiting to be played out.
Yeah, thanks, Kenneth. For Darius, because we talked about disruptive innovation team just now, but maybe just zooming in very specifically onto that kind of opportunity in China and perhaps even other parts of Asia. Is your fund management team also seeing maybe perhaps more opportunities there, not just for this year, but perhaps on a longer term trend?
Right.
As opposed to a lot of it traditionally coming from the US side.
Yeah. So I think that's something that I wanted to say. I felt was quite interesting when I saw the poll earlier on, when the question was asked, what sort of tech would you be buying, right? Would it be US tech, Chinese tech, or global tech? And where we're coming from, especially from the disruptive innovation, we don't classify tech in a geographical kind of a manner. So if it's an energy storage, long story short, if it's a battery, there's no such thing as a US battery or China battery. I mean, you can have different places where it's manufactured, resulting in different quality or different costing, and thereby, whether that fits your business. So again, I guess what we're trying to say is when we are trying to, understand the companies or understand the tech, we're really trying to understand where the development has gone, which are the companies that are taking that development in that technology and bringing it the next step forward. So currently, yes, I think the US is leading the way, really because in terms of regulations, in terms of patents, they are a little bit more liberal on that front. And that's why, even just stepping aside, when you talk about the race of the vaccines that have been produced, obviously the US wanted to be the forerunners to come out and do something, right? But that's not to say that, a vaccine manufactured in Europe or, in China even for that matter, it's not as effective. And, this will lead us down another whole conversation. But I think that's also why I wanted to highlight that, because the moment you slap a label on something, just saying it's China or whatsoever, then that kind of creates a very strange stigma within the marketplace. And I think, as Kenneth brought out, the younger generation probably is a little bit less sensitive about that. They're just looking at it from an understanding perspective. And I just want to take one more gigantic step back to say, in the 60s or in the 70s, post World War II and all, yes, the US and all were making the fridge, the washing machines and everything first, but then who was copying them next? It was really the Japanese and the Koreans, and then now you obviously have everything that's made in China and all. So is it really a case of, is it a Chinese washing machine or a US washing machine? It's still a washing machine, but we need to understand where, kind of the tech is going and then play into that space. So in the long story short as well, rounding back to your specific question, are we adding to the Chinese, names and all that? The answer is yes as well, because say what you like, a lot of the idea generation does begin in the US, but the actual manufacturing goes into China, right? So even with Elon Musk, with Tesla and all that, they've created a second battery operations out of China. So it's quite feasible to say that these guys will learn the tech. People will learn from Elon and then leave the company, start up, or they will get poached and so on and so forth. So the tech will eventually become prevalent in other countries, and we might see, even more development from there. So the answer is yes, we will be adding as well when we see the right opportunities and the development coming out from different locations.
Thanks, Darius. Maybe I'll just wrap up this theme on US, China, and I'll bring Wei Ren in especially from a more asset allocation point of view. How should investors perhaps look at the China position? And also maybe within China, should we go for more H shares, A shares, or Greater China?
Personally, I think China is a market that is relatively underrepresented in perhaps most of investors' portfolios, which is interesting because China is actually the second largest economy in the world right now, but yet I don't think investors have a lot of exposure to Chinese equities. I think a few reasons why. I think the prevailing impression of Chinese companies is that I think people tend to think of Chinese companies as fraudulent. They're just frauds waiting to be discovered, which I feel is a bit unfair to Chinese companies, because there are really quite quality companies out there for investors to invest in. So personally, I think China as a market, it is relatively underrepresented in portfolios. And I think if China were to eventually overtake US as the largest economy in the world, then I think China is probably going to be one of those allocations that is going to stay in the core allocation of a portfolio, just like how we see technology as being a core part of our portfolios as well. And not just for equities, in fact, for bonds as well. China has the second largest bond markets in the world, but I don't think investors have any exposure to Chinese bonds inside their portfolio. But yet, the interesting thing is that Chinese government bonds, they're offering much higher yields than what you're getting from US treasuries and also other major bond markets out there in the world. So I think China is an interesting market, underrepresented, overlooked, underrated. So I think if there is one market that you want to consider adding exposure to, I think China could be one place that you could start looking at.
Yeah. Well, it's very interesting that you brought up fixed income, because that's the next topic I would like to go into with the panel. And it's really from a more asset allocation kind of a point of view, and therefore, you can't run away from thinking of equities, but especially fixed income as well, just to add that, the balance in the portfolio and to reduce the correlations, especially perhaps between the different asset classes. And you mentioned Chinese bonds, so I'll bring Darius in, because Nico did launch a Chinese bond ETF late last year.
Yes.
So perhaps tell us why we should be looking at Chinese bonds in our fixed income portion of our portfolio,
right?
Whether it's from a yield perspective and so on.
Yeah. So I think just riding exactly off what Raven just shared, it is a very all the superlatives that you use, I think underloved will be the one that I would just add as well. And I think it's a general misconception, because maybe say 3-5 years ago, you see a lot of maybe, media putting China bonds kind of like as junk bonds, or super high yields, etc., paying ridiculous kind of yields, and the chances of defaults become very, very high. But I totally agree that as we look at this space, we see the balance sheets, we see the P P&L, we see the accountability of a lot of Chinese companies improving over, the last 3 to 5 years. And so much so that, it's still berserks, because I think what we've always said is that the rating agencies have got it wrong for a very long time. Credit to all of them, they're doing great work, but we do think that they are very backward looking and they're not really forward looking, because why would a Chinese company that's 2 times, 3 times the size of, say, any other normal US firm, but still be rated, at best triple Bs or, A minus, and still have to pay something like 2 to 3% coupon when, the guys out of the US and whatnot, by sheer reputation, they may just be only required to pay a 1%. So on the yield front, I think that's where I am totally in agreement. And because it's so underrepresented in most people's portfolio, I think that's where a lot of them have also just look more towards the equity rally. So again, obviously equities have run 20% at minimum, right? And then you look at this little space and say, oh, well, I'm getting only 4%, only 5%, which I think backs back to your question about, managing risk. So if you had, and I think Geraldine was saying that 90% of people have done very well, or was it 70% have done very well? I think that's the key question, right? If you are ahead, are you now going to take more risk, or stay in the game as people will like, or are you looking to maybe take something off the table? And if you're taking off the table, where is a under-loved, valued kind of play? Yes, it could be fixed income just to safeguard your returns, because right at the beginning, I said one of the key lessons I learned about 2020, right, is how quickly things can swing in a very, very drastic manner. So while we're still on a nice little run-up, who's to say that something's not just lurking around the corner and you kind of almost wish I had a safe haven for it. Yeah.
So what's your idea of a good safe haven for investors?
So I guess my good idea of a safe haven really largely depends as well on what the investor's horizon is looking at. And to be very honest, I guess I'm in a privileged spot where, as a personal investor, I don't have any short-term needs or short-term goals that I have to, set aside monies for. So while I say that China is a very attractive spot from a fixed income perspective as well, I am almost 100% equity kind of a guy. And that's really because my horizon is 20 years, 30 years on the lookout. But again, yes, if some folks, unfortunately, in a sense, don't want to take on that much risk, and because of whatever needs and all, then I think the call is to be a little bit more sensible at this point in time. If you have already done that 50%, 70%, so on and so forth, take Warren's advice, right, who he took from Warren Buffett. Don't be greedy, right? When markets are greedy, you be fearful, and when markets are fearful, you be greedy. So do a bit of a rebalancing, which is, always a sensible thing to do.
Thanks, Darius. Kenneth, what's your main risk concern off the top of your head for this year?
I think naturally it's the political one between US and China, which we've talked about. Because I think in just the last week, we've seen how unstable the situation right now is in the US and how that actually ripples across the world, because I think most of the top companies are all listed in the US. So I think that's the big one. I think second of all, of course, is the COVID situation as well, like how that plays out and how that impacts multiple parts of the other economy, right? So retail, you have, of course, travel, which we hope we can get back soon, and everything else, right, around the economy, financials as well, because of the interest rates and things like that.
Okay. Yeah, thanks, Kenneth. David, we talked a bit about the risk parts here. So what's your biggest concern for this year?
It's not so much a concern, John Paul, but in fact, it's things that we should be aware of. And I think the first one is that the recovery is not going to be even. In other words, there's going to be an uneven recovery. And I'm not talking about just companies. I'm talking about individuals. Not everybody is going to be going back to a job in 2021. So in that sense, I think unemployment is going to be a big concern. I think that the falling US dollar is going to be a big concern. I think national debt, there are lots of countries out there that have borrowed heavily in order to try and get their economies and try and help their own nationals during COVID-19. So that debt has to be paid off at some point in time. We may not be the ones that pay it back, but certainly our children will be paying it back. Our children's children will be paying it back. And to to labor the point, our children's children will be paying back all of that debt because the huge amount of money that has been borrowed has to be repaid. So just following on from what Darius said, I mean, Darius is investing for the next 20 or 30 years.
Yeah.
I am investing, not that I'm going to be living for the next 100 or 200 years, but I'll be investing for future generations as well. So therefore, I will have to pick stocks that will be able to outlast not just me and my children, but certainly my grandchildren as well.
It's long-term planning. Yeah.
Long-term planning, yes.
Yeah. So I think we talked quite a bit about equities. So I'll bring Weiren in on fixed income. Within the fixed income space broadly, what's the 1-2 segments that stand out for you?
Okay, I think first and foremost, I just want to say that fixed income's role in our portfolios is not something that gives you, exceptional returns like equity markets. That's not what fixed income is for. Fixed income is there to help you to protect some of your returns when a market crisis comes, as we have seen earlier this year. So I think it's not so much about where the opportunities in fixed income are, but I think you should always have some sort of exposure to the safer segments of fixed income. So I think investment grade is something that you should have as the anchor of your portfolio. But of course, if you're on the lookout for opportunities in the fixed income space, I think from your perspective in the IG space, I think Chinese bonds definitely something that investors can consider. And also, if you are an investor that has a higher risk appetite, if you're willing to venture into the high yield segments, then I think the high yield and the emerging market bond space is perhaps the areas within the fixed income universe that still offers fixed income investors some sort of value. So I think a high yield space is one, and I think particularly Asian high yield, I think investors can still consider this space. And I think emerging market bonds is also something that perhaps investors can consider. And if you think that the US dollar is going to further depreciate this year, then perhaps taking a position on emerging markets, local currency bonds, that would be something for investors to consider as well.
Yeah, that's a good point, Weiren, because EM debt, traditionally, I think for a lot of investors, we look at it from a USD perspective, but there are options in the marketplace for EM debt in local currencies. So with USD depreciation in mind, which is kind of like alluding to, we think it's going to depreciate, right? Perhaps for this year. I think David mentioned it as well. You're looking at it as a long-term depreciation, David, for the US dollars?
I think so, and I think, for a number of reasons. I think, first of all, the interest rate differential between America and probably a lot of the emerging market currencies will make the emerging market currencies slightly more attractive. Secondly, we've got this twin deficit in America. We've got the budget deficit and also the trade deficit. And in terms of the trade deficit, Americans like to buy foreign goods. I mean, there is no doubt about that. They like the fact that we produce cheap things over here in Southeast Asia. So they like Vietnamese shoes. They like T-shirts made in Thailand. So therefore, they're going to have to print a lot more US dollars in order to buy these kind of goods. So when you have all of this together, I think the US dollar will continue to weaken in 2021, but that doesn't mean that you have to stop buying American shares. It's actually good for American companies that have operations over here. Every time you go out and buy a Starbucks coffee, when they convert that back into US dollars, because the US dollar is lower, it will flatter the profits of Starbucks. Same with McDonald's, same with a lot of these American companies that have operations over here. So don't be too concerned about the low US dollar, but be aware that the US dollar could fall in 2021, which is a great buying opportunity for long-term investors.
Yeah. Okay, I think we'll move on to the last theme of our panel discussion. We've heard a lot of good views and ideas so far. So in terms of the strategies for our investors out there, what's one thing that they shouldn't do this year? So maybe I'll throw that question to all of you. Yeah, starting with Darius.
What's one thing they shouldn't do this year, right? Just to get the question
Yes.
right. I think they shouldn't be buying on panic or fear. So again, borrowing what David said, keep calm, right? And just understand what's going on in the investment arena. And the worst thing you can ever do is to buy on impulse or to buy, without properly considering what's your your long-term horizon or your intention of investing in the first place. And I think even before we stepped on this panel, we were all just joking, at the back, like, is Bitcoin the thing to come into right now? Sure, if you buy at 40,000 and you sell it at 40,500, but what if tomorrow, valuations swing, right? And it drops just because of what Kenneth says, another panic, because they storm Congress again and whatnot have you. So I think the reality is let's not be overly reactive. Let's plan it out. And obviously, because there are going to be different kind of investors out there in the audience today. You have your tactical, opportunistic guys because they have money sitting at the side waiting to be deployed. And I think that's where, we've talked a lot about where we saw some of the undervalued areas that they could consider. But I do think another thing that they can consider to mitigate risk and, just to deploy as a strategy for 2021 is really to do just regular dollar cost averaging, your good old buy in every month, select a basket of products to invest into, and then just stick to your routine and, just average it out. Especially if you think that there's going to be more volatility this year, then you don't want to be buying at the wrong time. And again, I think I saw the polls. There were some people that said we bought at the wrong time, right? We bought high, we sold low. So these are some of the things I think if we were really to, take it more from a strategy perspective, not talking about asset classes or stocks or whatsoever, back to the good old investment wisdoms that we should be using for 2021.
Yeah, it's a good point because I think half of the respondents said they missed the lows
Yeah.
last year, but 80% of them said at least their investment ended in the green by the end of last year, so that's a good thing. Doesn't always mean we have to catch the lows
Yes.
in order to be profitable
That's
in
right.
the longer term. So Kenneth, for yourself, what's one thing what's one thing you would tell investors not to do based on your experience?
Yeah, I definitely agree with Darius, especially with the whole crypto rally now. Even you walk into a coffee shop, like you will hear people legit talking about like crypto, and I think at a point usually is when things get a bit frothy, right, bubbly as well. So I think let's see what happens and don't FOMO, because FOMO is very real, especially in the connected age that we are today. Last time you just read the newspaper, right? It doesn't actually tell you much about what other people are doing. But right now you go online, there's a community of 20,000 people, everyone's sharing a different idea. And when the momentum picks up, there's a lot of FOMO that goes into a decision, and don't let that cloud you.
Yeah, good points. David?
Never ask a barber if you need a haircut, right? Because he will always tell you that you need a haircut. And I think the same goes with what Kenneth has said. If you go on discussion boards that are talking about cryptocurrencies, they'll tell you to buy every single cryptocurrency out there. Similarly, if you go on a forum that's talking about gold, they'll tell you that gold is going to go up in price. So never ask a barber if you need a haircut.
Yeah, excellent point. Weiren, for you?
For myself, I think my advice is don't let your emotions get in the way of your investment strategy. I think for many investors earlier this year, I think because it doesn't feel good to see an investment portfolio go down in value, I think most of them have sold to cut their losses. But it turned out to be actually a good buying opportunity. So I think in 2021, we probably will see volatility come back again. I'm not sure if it will, but I think volatility seems to be the norm right now. So if a sell-off comes, I think you should take the opportunity to add exposure into equity markets. And also, like what Kenneth said, FOMO, another thing that you should avoid. I think you shouldn't chase rallies. You should only buy if this is a company or an investment that you personally believe in.
Okay, I think it's a very excellent point as well. So I think we'll go back to the theme for this event, what and where to invest in 2021. I'm just gonna ask each one of you to give me your favorite market that you want to invest into.
Market as in geographical market or
you.
asset class?
Idea-wise, asset class,
Right.
market sectors, and so on. So
Right.
Darius?
Sure. I think end of the day, while we have a very successful disruptive innovation fund product, I would just like to say perhaps taking a step back and reclassify everything more as a global equity. Because again, this is something I will talk about later on in the afternoon. But while the whole disruptive tech and all that sounds very tactical, sounds very niche, when you look at that particular portfolio, you're actually getting kind of almost a global equity quasi-like, because we don't own the Facebooks, the Amazons, and all that there, but you have that global equity portfolio, or your multi-asset portfolio for that matter, that will own some of all these things. So, and again, I'm biased because, like I said, I've got a much longer horizon. So I'm more inclined, if I have to in 2021 to toss my money in, I would be tossing it in the equity market. And I think, yes, a global remit sounds a lot more logical, because there are more than just the US markets or the China markets to find opportunities and gems. Yeah.
Okay, thank you. Kenneth?
Yeah, so I think for me, always invest in a future that you want to see personally. So personally, I'm a big techie and I'm a big fan of everything related to innovation. So innovation, ETFs, for me, would be the way forward.
Okay. David?
Well, I think this is a stock picker's market. It always is a stock picker's market. And opportunities are around us all the time. And the harder you look, the more you will find. So if you want to be successful in 2021 and beyond, spend your time looking for opportunities and you will find them.
Okay. And Wei Ren?
Personally, I think the place to be in for 2021 is actually equity markets, because of the low interest rate environment that we're in. And also within equities, if you want to look out for opportunities, I think emerging markets is something to consider. And also from a sectoral level, like I mentioned just now, I think if you want to pick a sector that could potentially outperform in 2021, it will be the financial sector.
Yeah. I kind of agree as well. So I think equities versus fixed income, I'll pick equities as well. And within equities, we're looking at, in terms of regions, at Asia ex-Japan for myself. And within that region, China stands out. And for sectors, financials as well. So that brings me and the panel to the end of what we wanted to really talk about. We can go on for quite long, but time is up. So thank you so much to my panelists. Thank you to the audience for joining us. There's still so many topics, so many investment ideas to be shared later on. So with that, I'll thank you and invite the next segments to begin. I just wanted to perhaps also take this chance to remind investors of the benefits of regular savings plan, something that we strongly believe in at FSM1. And for the next 6 months, starting from the RSP cycle in February, we are going to reduce the commission rate on ETF regular savings plans to 0%. So that's being shown now for the audience. So more details to come on our website. Thank you very much.
Thank you, Jean-Paul and the panelists. We'll now proceed to the conference stage, where we have with us Mr. Colin Lowe, our Senior Macro Research Analyst. Colin is responsible for the analysis and research coverage of global markets, as well as the generation of actionable market views for various asset classes. He's also a part of the portfolio management team that manages FSM MAPS, discretionary investment portfolios, and is responsible for the development and implementation of strategies across all the portfolios, as well as its product selection across both fixed income and equities. Today, he'll be sharing with you the IFAS research team's investment outlook for 2021. It'll be several minutes while we head over to Colin. In the meantime, don't go away for too long, as we'll be back with you shortly. FSM1.com will also be showing you several attractive promotions coming your way. Look out also for the exciting sessions that are coming up for the rest of today.
Hi, a very good morning, ladies and gentlemen. So, a warm welcome to What and Where to Invest 2021. So, I'm Colin, the Senior Analyst for Macro Research Team, and today I'll be bringing you guys through the IFAS Outlook 2021, and more importantly, what and where to invest in this year. So, let's kick things off with laying out the backdrop for the macro outlook this year. So first, I think for investors, it's critical to know what phase of the economic cycle we are in right now, because it has implications on your corporate profitability, your economic growth, as well as to help us with the asset allocation decision. So in simple terms, it is telling us where we will be and help us understand how to get there. So I think the good news is here, that we already passed the trough and we are at the early phase of the economic expansion, and we will be entering a global cyclical recovery. So over the next couple of slides, I'll explain why some indicators are pointing to that. And these indicators are very sensitive to the economic activities and therefore are good leading indicators. So firstly, global PMIs. So as seen from the table right here, you can see that from the July and August period onwards, PMI has rebounded significantly in a sustained fashion as well as a synchronized fashion over the DMs as well as the EMs. So this is a good sign to tell us that, hey, we're out of the trough and we are recovering indeed. And I think if you look across the board, the broad-based recovery itself also lends credence to our belief that it is a global, broad-based cyclical recovery. So if you can take a look here at the the global trade as well as global export numbers. So these are indicators that are very, very cyclical and very sensitive to economic activities. So on the chart on the left-hand side, you can see that World Trade Volume Index, as well as the year-on-year change itself, has rebounded back to pre-COVID levels. And on the chart on the right-hand side, if you look at the top 5 global exporters, you'll find a recovery in exports in almost a very synchronized and sustained fashion over the past couple of months. So all in all, the trade and export data are implying that we are out of the trough right now and the cyclical recovery is kicking in. And last but certainly not least, if you look at the metal markets, so metal markets are also very cyclical and the prices themselves actually reflects the market's expectation of recovery because of its economic usage. And if you look at the chart on the left-hand side and look at the raw industrial metal index, you'll find a robust rebound since a March low, and this mirrors what we have seen coming out of the recession over the past few cycles. So you have to dig a little deeper into that and look at the particular prices of metals, such as your copper, your iron ore. You'll find that, hey, prices actually rebounded quite a lot last year. And this particular rebound in price is important because that reflects market's expectation of a positive global recovery. So now that we have laid the groundwork for the potential case for a cyclical recovery, our outlook for this year remains very constructive. And we believe the biggest theme this year will be a vaccine-led cyclical recovery. And if you look at the GDP growth across all the nations and all the different sectors, all the different regions, we'll find that we expect above consensus global GDP growth of 5.8% this year. And particularly across the different regions, you'll find Asia, particularly China, should lead global growth this year. So now that we have laid a foundation for the macro outlook, so let us jump into the equity outlook this year. So I'm sure many of you know that valuations have in fact surged over the past 3 quarters and now elevated to heady levels. So we believe that numbers right now actually priced in a recovery for this year as well as the next year. So if we can take a closer look at the chart here, you'll see that, hey, the multiples themselves are trading above the historical means for most of the markets. And in fact, while some of the markets are trading at the top range of a 10-year historical average. So with that said, while valuations remain high, our outlook remains positive this year. And our optimistic stance is supported by 4 key reasons. So number one, we do expect a positive, robust EPS recovery this year, and that itself will be driven by the cyclical sectors. And number two, we see supportive macro and as well as a policy backdrop. So with the likes of low interest rate and heavy central bank support to resume and to maintain this year. And thirdly, based on our projection, we expect stronger returns for equity markets over fixed income. And lastly, if you look at the risk side of stuff, we are expecting a milder risk backdrop this year, and that itself should be positive for risk assets such as equity markets. So all in all, this points to our preference for a pro-risk as well as a pro-cyclical exposure this year, and we recommend investors to hold a modest overweight of equities over fixed income. So with that said, having established our preference for pro-risk as well as a pro-cyclical exposure, we believe to best express this are 2 regional equities, which are emerging markets as well as Asia ex-Japan. I think aside from that, the embeds the cyclicality tilt that we so favors. And also beyond that, on a regional basis, the outlook for EM as well as Asia ex-Japan equities remain very favorable, and we are expecting strong returns this year. So broadly speaking, I believe that 2021 will be the year for EMs, and there are several factors that I will go through over the next couple of slides to highlight so. So firstly, we are expecting a robust growth rebound that is in the works for emerging markets. So if you can take a look at this chart right here, historically, coming out of the recession, growth has been very strong, and in fact, growth itself has been stronger than historical average of 5.5%. And because of a cyclical tilt, as well as a possible uplift in the commodity cycle, we are expecting a stronger than consensus forecast of a growth rate for emerging markets this year as well as the next year. So the second reason is that for EM equities, we believe that they are ready for a strong cyclical rebound EPS recovery. So similar to the slide that I just presented, coming out of the recession or coming out of the tail end of the cycle, we can see that there is very, very strong cyclical EPS recovery for emerging markets. So the range typically comes out to about 30 to 60% across the past few cycles. And the key reason is because EM has a huge cyclical exposure at about 60 to 70% of the entire index. And therefore, if you look at our projection this year, from a bottom-up basis, we are expecting a growth rate of a high double-digit growth rate of about 37% as well as 27% for this year and the next. So another thing you might notice here is that our projections remains higher than consensus estimates. And the key reason underpins that is because when we look at EM equities from a sectoral level, we'll find that, hey, consensus are in fact actually more conservative on the estimates. And because of that, we see an impetus for positive price reaction that is coming from earnings upgrade this year and next year for emerging market equities. And moving on to my third reason, shown quite clearly on this slide, is that the US dollar actually moves in waves, and right now, because of the recent weakness, it's a clear sign that it is in the initial phase of a multi-year down cycle. So this has huge implication for the emerging market equities, because if we can take a closer look at this chart, you'll find very strong negative correlation between the dollar strength as well as EM performance. So meaning to say that whenever a dollar weakens, EM performance strengthens. So if we were to expect a multi-year down cycle for the US dollar, similarly, we can expect a multi-year support for emerging markets equities. So in this case, I might be wrong, and I've been wrong quite a couple of times. But if you look at this tight correlation here, I think that lends credence to my belief that we will see multi-year support for EM equities moving ahead. So moving on to my fourth and final reason, we believe the commodity upcycle is about to kick in this year, and we see two reasons that supports this. So firstly, we see a demand and supply mismatch in many of the commodity complex. And the second reason is a weaker dollar. So like I mentioned earlier, a weaker dollar itself is good for EM equities. So it also helps with commodity prices. So the chart on the left also shows quite strong negative correlation between the dollar strength as well as the commodity prices. And then whenever the dollar weakens, commodity prices appreciates. So this has a really good, really significant implication for EM equities, particularly on a fundamental reason. So as seen from the chart on the right-hand side, you can quite clearly tell that rising commodity prices actually help boost EM corporate profitability. So with more in detail regarding that, you can see that whenever commodity prices rises, it leads corporate earnings for EM equities by about 3 months. So that is a very clear indicator that we are expecting earnings to recover for EM equity markets. So to put things in perspective, what we really see in emerging markets equities right now is that there is a huge cocktail of tailwinds that is supporting emerging markets. So this particular combination of a dollar, commodity cycle, as well as cyclical growth and EPS recovery itself, the last time we saw that was more than 10 years ago, right after the GFC. So what we are expecting right now is the combination to carry emerging market equities forward this year. And with that said, we are expecting an attractive upside potential of 70% by end 2022. So for Asia ex-Japan equities, we believe it has the best risk-reward offered amongst EMs. So as a side note, much of the Asia ex-Japan equities itself falls under the EM universe and therefore are uplifted by similar tailwinds that the EM experiences. So for example, the weaker dollar as well as the cyclical economic growth and cyclical EPS recovery. And aside from that, we view Asian ex-Japan equities as the least risky segments amongst EMs and therefore having the best risk-reward offered. And with that said, we are expecting a strong return of about 18% by end 2022. So here is something interesting about Asia ex-Japan equities. So as can be seen from this chart, which is the FSMI Asia ex-Japan equity performance chart. And this chart in fact, is the aggregate of the performance for all Asia and Japan equity funds on our platform. So a quick look at this chart, you can tell that the trend is clear. Active management in the form of UT provides good long-term returns, and what we believe that is that investors should capitalize on this to gain the excess return that is offered to them by active management. So after covering the equity markets on a regional basis, here are our top single market equity picks for the year. So in summary, we favor China, Hong Kong, South Korea, Indonesia, and Brazil, and we see an upside potential between 18 to 24%. So you might notice that Brazil there stands out as it's not the Asian EMs out there. So that reflects our view that as the global recovery kicks in, investors should diversify into the EMX Asia region, and doing so, they will see attractive opportunities from regions such as, or single markets such as Brazil or even Russia. So having covered the equity outlook, so let us move on into the fixed income outlook. So I think it is important for you hunters, for fixed income investors alike, to first understand what is the yield and rates condition or environment around the world. So as shown in this chart right here, the major government bond yields have sunk to tremendously low levels over the past 4 decades, and particularly so over the past 3 to 5 years. So while we think rates itself are unlikely to sink much further, it is also unlikely to rise over the next 1 to 2 years. And with that said, as shown in this chart right now, the yields across the different fixed income segments remains at very paltry levels. So a quick look at that, you can find that yields itself remain below historical means for almost across all the different major segments. And certainly it is a mile away from levels seen in March last year. So the same can be said if you then take a closer look at this slide in terms of spreads across major fixed income segments. So spreads itself have compressed quite tremendously over the past 1 or 2 quarters. And for most segments itself, they are below historical average. So similar to what we observe in equity markets, valuation and fixed income have become quite full. But with that said, we believe value still can be found in select high yield segments. So this year, our recommendation for the fixed income segment is to favor high yield over investment grade. So broadly speaking, we see 3 fundamental dynamics supporting high yield. So number 1, it is aggressive search for yield. Number 2 is the rising risk appetite. And lastly, improving economic and credit fundamentals for both corporates as well as sovereigns. So with that said, Asia high yield remains our top pick within the bunch. And over the next couple of slides, I'll show some reasons why. So the first key reason is the beefy yield pickup engendered by the Asian high yield region. So what you see from this chart is that the Asian high yield segment itself offers a yield pickup of about 470 to 650 basis points over the investment grade peers. And it also offers a yield pickup of 90 to 350 basis points over its high yield counterparts. So this is important because in the current low yield environment, having such a high yield pickup itself is significant for investors, and this means it's a good time to enter into Asian high yield as well. But above and beyond that, if you compare to a historical basis, where you compare the blue chart, the blue bar chart and the green bar chart, you'll find that, hey, as an investor right now, I'm having a yield pickup that allows me to have higher than what I should be having across the historical average level. And moving to the second factor, if we look at spreads for Asian high yield itself, we believe that spreads itself are still very attractive because it is one of the few segments that is still above historical mean. And if you look at the possibility of spreads compressing to pre-COVID level, which we believe is a reasonable expectation based on the macro perspective, based on our macro outlook, we see ample room for compression. So there is about 200 basis point room for compression. And what that translates to is a very attractive potential upside once you account for the spread duration. So moving to my last point, if you look at the spreads, you do have to look at default risk in conjunction as well. So what we expect for default rates for Asian high yield segment is that we are projecting a default rate of about 2.5% by end 2021. So if you look at spreads level now, so what spreads are implying is a default rate of 4.1%. That is using a historical recovery rate of 40%. So in short, spreads compensates for almost double the forecasted default rate. And if you look across the spectrum for what is the forecasted default rate across a consensus, you'll find the most pessimistic estimates will be about 4%. So this also means that spreads right now adequately compensates for the worst case scenario that is forecasted by consensus. And with that said, I think that sums up why we favor Asia High Yield. But nonetheless, there are other segments that we favor, namely EM hard currency and EM local currency. So a key reason why we favor EM hard currency is because of its room for spread compression. So as shown from the table here, you can find that, hey, EM hard currencies right now is offering a spread of around 350 basis points. So there is quite plenty of room to compress to, say, a pre-COVID level of 260 basis points. And if you take account of its high duration and the spread duration itself, we believe the compression gains that is being translated to the total return of EM hard currency can be relatively attractive. And for the last reason, for the last segments that we favor, which is EM local currency, we also do see some room for compression, but at the same time, total return itself will be held by currency appreciation for the EMs. So right now, if you look across the board, EM currencies are some of the most undervalued currency against the dollar. So particularly, say, Brazilian real itself. So we believe, based on the real valuation methodology, Brazilian real itself somewhere around 20% undervalued as compared to the US dollar. So if you do add in currency appreciation to spread compression gains, then we'll find that, hey, EM local currency actually are relatively attractive at this current point in time. All right, so before I end off, I'd like to summarize what I have gone through in today's outlook. So for the macro portion, our view for this year remains very constructive. I think the big major theme of this year will be a vaccine-led and a secure recovery, and we are expecting an above consensus GDP growth of 5% this year. And for the equities, we favor EM as well as Asia and Japan equities. And that is largely based on our preference for a pro-risk and pro-cyclical approach. And with that said, our top picks within the markets remains China, Hong Kong, South Korea, Indonesia, and Brazil. And last but certainly not least, for the asset region, for fixed income, we favor high yield over investment grades, and our top picks remains Asia high yield, EM hard currency, and EUM local currency. And finally, for asset allocation-wise, we favor equities over fixed income, and we recommend a modest overweight of equities. Well, so that brings me to our last slide. So once again, I thank everybody for staying through together with me for this presentation. Thank you for your time. And before I end off, I would just like to say, please take care in this COVID environment out here. So see you guys next year, and goodbye.
Thank you, Colin. If you have any questions regarding the presentations today, you can ask them in the Q&A section by clicking on the Ask Question button. We'll have our speakers to answer the questions later on today. Coming up next, we have Will Sham, Director, Research and Portfolio Management from iFast Hong Kong, who is joining us from Hong Kong and sharing with us a special insight into the key reasons to look at China in 2021. Joining him is Mr. Ong Ziyang, also from the macro research team. Ziyang is a senior macro research analyst responsible for providing analysis and research coverage across global markets and asset classes at iFast Singapore. Take it away, gentlemen.
Hi everyone, welcome back to the FSM1 What and Where to Invest event. I'm Ziyang, Senior Macro Analyst with iFast, and I'm here today with Will, Director of Research and Portfolio Management with our Hong Kong office. Today we'll be talking about 2021 outlook for China, and more specifically our key reasons for investing in China this year. Like many other economies around the world, 2020 has been a challenging year for China. As the first epicenter of the COVID pandemic, its economic growth was badly hit in the first quarter, especially as the China government took on a slightly more draconian stance on lockdowns as well as travel restriction. However, things took a major turn for the second quarter as the outbreak were gradually contained within mainland China, and because of that, factories and manufacturing activities were allowed to restart under stringent guidelines. By the middle of second quarter, China were back on track to return to normalcy, while the rest of the world has just started struggling with the uncontrolled COVID outbreak among their respective population. Because of that dynamic, China is going to expand by more than 2% in last year. On the other hand, the rest of the world faced severe contraction, including Singapore, which shrunk close to 6% last year, making it one of the worst recessions in our 50 over years of history. So Will, can you briefly talk us through some of what's the current outlook for China right now?
Right, Jian. So, we have been very bullish on China, right, for both economy and stock market. Actually, in early last year, despite the pandemic disrupt the Chinese economy activities, we're one of the few firms to make a strong call that China will lead the world in economic recovery, and told our investors that they should start buying right now on the Chinese equity, especially the domestic consumption theme. Jian, yourself also write a number of Chinese-related articles at that period. I remember starting from March, right, to tell people stop buying the Chinese theme. Really good job, but not sure how many our client actually did follow. Because I remember at that moment, people in the street still doubt that whether Chinese economy can recover that fast, and also whether the Chinese government can really control the pandemic. But ironically, not sure how many of you actually see a very interesting picture in the internet that compares to Wuhan and also New York in New Year's Eve. It was so crowded in Wuhan as people rush in the street to celebrate. Somewhat you can feel the joy of the people. And while there was no one or almost no one in the street in New York due to the economic lockdown. So I think this is a very classic picture of the pandemic to actually conclude the pandemic, that to show how China has recovered and actually back to normal, while the rest of the world, as you mentioned, are still struggling. So first of all, on the economic front, to 2020 full year GDP growth in China is estimated to be around 2.2%. The figures look a little bit low, mainly dragged down by the plunge in the first quarter. But since then, actually the economic growth was back to positive territory. So looking ahead, for 2021, we expect the economic growth to hit 8.5%, which could be one of the fastest growth rates among the major economies. And I think, I think that it is not a very aggressive target, because if you look around the major economic or the GDP components, one of the notable driver this year would be the manufacturing investment. This has been the key components of the fixed asset investment, and but unfortunately it was rather sluggish over the past few years, because the overall manufacturing sector was first hit by the supply side reform since 2015 to cut the capacity. So you can see that manufacturing PMI is always below 50 threshold, stay at the contractionary territory over the past few years. And then the sector was once again hit hard by the pandemic. But we actually expect the worst has been passed, and the sector will make the key contribution to the GDP growth, over GDP growth this year. And other point I would like to highlight is that last year, the Chinese Central Bank, PBOC, actually cut its interest rate by 2 times, and also lower its RRR, required reserve ratio, by 3 times. So this has successfully boosted the credit and also liquidity environment in China, as proven by these 2 charts. We call it as double expansion in credit, which is the rebound in both M2 and also the total social financing numbers. So historically speaking, as you can see, double expansion in credit is actually quite a favorable background to the stock market, like we experienced in 2009, 2012, 2014, and also last year. So I would expect that this background will continue in 2021. So overall, both economic and also the liquidity background is quite favorable to China.
All right, I think that's quite an interesting point. I mean, because for China market, it has been quite, it's always a market that is very sensitive to its economic condition. And it does sound like the economic conditions have started to improve leaps and bounds since first quarter last year. I mean, historically, the performances have exhibited a high correlation. So with that in mind, with the country starting 2021 on firmer foot versus the rest of the world, what do you think the outlook of China equity market will be like ahead?
Right. So I think both earnings and valuation remain very supportive to the Chinese equity. As always, we have been very bullish on the Chinese equity stock market. I also believe there are still many exciting investment opportunities inside the market. So by breaking down the two major determinants of the investment values, first of all, on earnings side, I like to use some leading data to study about the earnings trend for the top-down approach. So like PPI on the left-hand side, which represents the profit margin of the industrial enterprise. It was historically led by M1 minus M2 growth rate by around 6 months. Okay, the difference between M1 and M2 in China is the corporate deposits. So you can think about like the liquidity in the corporate sector. The logic behind this chart on the left-hand side is that, as we mentioned, we've seen more favorable liquidity environment in China, and corporate liquidity has been improved. So it does help the corporate investment and end up being reflected in the rising PPI, which means improving profit margin, right? On the other hand, for the chart on the right-hand side, profits of the major industrial companies is led by the value-added industrial outputs, which represent the revenue of the industrial companies. So we combine all these four indicators to formulate a composite index called the earnings leading composite. So if you look at the earnings leading composite, it shows a strong, which shows you a very strong leading powers to the EPS, the earnings of the MSCI China index. So it lists around 3 months by quarter. So if you look detailedly at the latest figures, the latest numbers, it is very promising, and it actually implies that the earnings growth should follow in the coming months. So from this chart, I think I would expect more earnings upgrades to come going forward. And I'm actually quite confident that the fundamentals, which is the earnings of the stock market, will do well. So on the other side, on the second part, valuation, I think Chinese stock markets remain rather cheap if compared with its historical level or to the level of other major countries. So one thing I want to highlight is that for the Chinese stocks listed in Hong Kong, I expect to see a turning point in valuation. We have criticized the Hang Seng Index companies for so long that their index are not competitive enough and mainly dominated by the slow growth, mature companies. But last year, they finally did something to reform. They include W shares and S shares, weighted voting stocks, and also the secondary listing stocks. Finally, so MSCI China Index has been doing so for a long time, for so long. But okay, I think the Hang Seng Index company still giving a 5% cap, maximum cap, the rating to these stocks. But it's okay, at least making the first step. So the first batch of the change in the constituents of the Hang Seng China Enterprise Index was done and be effective on 7th September. And the second batch was actually announced and be effective on 7th December. So from this table, we can actually see some of the key change of the constituents, like the Alibaba, Xiaomi, Meituan, JD, and also NetEase. So these all faster growing new economy stocks were announced to be included, while those old economy stocks with lower growth potential were removed. So the newly added stocks have much more faster earnings growth accompanied with the higher valuation. We expect the index company will include more exciting names and fast growing stocks, as there will be more new economy stocks to be listed in Hong Kong, because due to the escalating China and US tension, and US may consider restricting more Chinese companies from raising funds in US. So yes, this table shows you that this will by adding more this kinds of very exciting, fast-growing names into the index, and you can expect the overall macro background is that the rising tensions between U.S. China, so which will force many ADRs. The U.S. listed Chinese company will come back to H shares or A shares for the secondary listing, and not even to mention those the Chinese unicorns, those unlisted tech companies allow more favorable doing IPOs in Hong Kong. So this will be, I believe, this will be the key catalyst, to lift the earnings prospect of H shares, and also will trigger the valuation re-rating of the market.
Right, I think that's very interesting that you spoke about the reality of Hong Kong equities, H equities being affected because of a lot of valuation problems. I think there's another issue with Hong Kong listed China shares is that it has been brought down by a lot of different other factors. Other than the COVID situation, US-China tension has been something that has been facing equities like that, as well as of course, the internal Hong Kong riots that we have seen over the last 1-2 years. So yeah, maybe can you talk us through some of the risks of investing into a China hedge right now?
Yeah, sure. As you mentioned, Dian, the key risk remains China's US tension. I believe this, of course, will be one of the most dominant factors or risk factors that will drag down somewhat the market performance or create volatility from time to time, because I personally believe that US containment policy on China is not the Trump's or the Republican unilateralism, is the national policy, and I would say that both Democrats and Republicans, or both Biden or Trump, are hawkish towards China, but they just have different approach. Like Biden's, I personally believe that Biden's belong to more to multilateralism, and his diplomat policy is to unite all the allies to boycott other countries or the competitors. He once even said that Trump's trading policy and also the relationship with European allies actually disarmed himself and also the country. So I think that the tension will rise from time to time and create market volatility and correction, and Chinese companies will be sanctioned and restricted asset financing or listing in the US. But this is not happening first time, right? We have been seeing this since 2018, and I think it will create, of course, it will create market volatility and correction like before. And those sanctions will spur Chinese firms to rely more on themselves, like for R&D, and some local firms will, of course, benefit from increasing local investment driven by the central government, and also the ADRs will come back to Hong Kong and China for secondary listing to avoid the risk of delisting. So I think the risk overall is still manageable. Another risk is anti-monopoly investigations on those big tech firms. But to be honest, that would impact more on Alibaba than other firms, I believe, and many other big tech like Tencent and Meituan are actually quite unrelated to the Alibaba case, but they also suffer from indiscriminated sell-off, meaning a buying opportunities for investors. So I believe that some firms even can benefit from this kinds of investigation, like Pinduoduo. Actually, their share price rose a lot during the period. So don't be overreact to this.
Okay, I think that's quite an interesting point. We can agree that you can't just look at the risk. You need to balance it with risk reward. So for the risk reward prospects for I think China equities ahead, it's actually still quite favorable for investors. I mean, looking ahead with China possibly becoming the largest economy by 2026, which is just 5 years' time, and its population getting richer along the way. What are key sectors and themes that investors can focus on identifying exciting investment opportunity for this upcoming year?
Yeah, actually, I'm more bullish on Chinese bank, Chinese telecommunication sector, which is dominated by Tencent, and also the consumer discretionary sector, which is dominated by the e-commerce players. So first of all, the reason I know Chinese bank one of the most ignored sector over the past decade. Many bad news against these sectors like the rising NPLs, non-performing loans, worsening credit quality, etc. So this caused valuation contraction and resulted in a weak performance of the sector. But actually, the earnings were not that bad. Like as you can see from this chart, from 2010 to 2013, major Chinese banks can still record positive earnings growth in every year, each year. So just that the share price didn't really react positively and remain moving sideways. And from 2017 till now, the development has been very similar. But as you can see in the current cycle, the share price keeps decreasing rather than moving sideways, no longer moving sideways anymore. So as such, the overall PB ratio once dropped to the record low level of around 0.46 times in September last year. But since the pandemic has been under control and Chinese economy is gradually recovering, so I believe that concern over the credit quality will reduce, and also the risk-free rate. Actually, last year, the Chinese government bond yield, the 10 years yield, has surged quite a lot in last year. So which will definitely improve the bank's net interest margin, at least for the major Chinese bank, will be improved. So I believe that which will also increase the possibility of valuation re-rating. And for the other part, the reason I like Chinese telecommunications is that so why I like Tencent is that the Tencent is expected to reach 20% of the earnings growth in 2021 and 2022. So which means that over the next 2 years, the earnings growth of Tencent remains very promising. And I personally believe that the estimated figures is achievable. Because if you look at the online gaming sector, it contributes the most to the Tencent revenues. And its mobile game business actually accelerate in last years. So the only problem is that is revenue growth from the enterprise service sectors slowed down a bit as impacted by the pandemic. But if you look at the subsector of this overall enterprise service, like the fintech sector, it still recorded a year-on-year growth of more than 20%. So, which is definitely not that bad. And once the worst of the pandemic is past, I believe that this part, the revenue contribution from this segment will definitely come back. So I'm quite bullish on Tencent's earnings going forward. And if you look at the earnings by sectors, apart from the telecommunication that I mentioned, another part is the e-commerce. So if you look at telecommunication and e-commerce, the earnings growth remains very robust, especially for the e-commerce. Because I just give you some macro data, like the Chinese online retail sales take up about 24% of the total consumption, and the online shopping still have room to grow in the future, even if the total online retail sales once plunged because of the pandemic and also the logistic disruption. in March or in the first quarter of last year, but then it rapidly rebounded soon after the pandemic was under control and the economy recovered. So the online retail sales far outperforms the overall social consumption in terms of the growth rate. And overall consumption in China only had a low single-digit growth rate. So they still need time to fully recover. But we are talking about over 15% growth for online retail sales. So from there, you can imagine that if e-commerce the growth rate of e-commerce remains very robust and is forecast to have a faster earnings growth over the next 2 years, as demonstrated in this table. So that's why I still bullish on this e-commerce players.
All right, so to wrap up, I think the three main takeaway that investors can take is that moving forward, the three sectors to look up for is actually banking, the telecommunication sector, which is like Tencent, and then last but not least, the e-commerce players like Alibaba, JD, etc., which has still a lot of headroom and a long runway ahead for them. Thank you for your insightful sharing, Will. I believe our investors are now more informed and more confident about the key reasons to invest into China in this year ahead. If you guys have any questions for Will or about investing in China, you can catch us at a Q&A session happening later at 2:30 today. Once again, Will is the Director of Research and Portfolio Management in our Hong Kong office. Thank you.
Thank you to Yang and Will. We'll now head for a lunch break and the broadcast will resume at 1 p.m. right here. If you have any questions regarding the presentations today, leave them in the Q&A section and we'll have our speakers take these questions later today. Later on, we'll also be giving away $100 worth of FSM1 multi-currency cash account credits to 3 lucky winners in the daily quiz. So be sure to pay attention to the presentations in order to answer them correctly. And don't miss out on our exciting presentations coming up later on as well, as we'll look at what is next for the Singapore market, as well as the emerging opportunities in Asia presented by Ken Wong of East Spring Investments. We will also be definitely not one to miss Mr. Tan De Jun's presentation about the future of digital economy in the wake of the COVID-19 pandemic. Plus, we'll have Catherine Wood to share with us an exclusive insight into the Nikko AM ARC Disruptive Innovation Fund together with Darius Fu from Nikko Asset Management. Do also check out the unit trust promotion starting today. Receive $10 bonus units for every $10,000 invested in any of the 21 unit trusts from our top 5 markets and 4 favorite themes. Which are these 21 funds? Head over to fsm1.com to find out. This promotion lasts from 9th to 31st of January. You can also, for a 6-month period from 8th of February 2021 to 31st of July 2021, enjoy a 0% processing fee when you transact via a regular savings plan. There's no better time to get started with ETF RSP. Open an fsm1.com account in just 5 minutes today via MyInfo. From the 9th of January to the 26th of January, open a new FSM1 account to receive 3,000 rewards points. To enjoy this promotion, you must click on the Promotions tab on the black menu bar and complete the form via the Account Opening Promotion form. Then click on the Submit and Proceed to Account Opening button to get to the FSM account opening page. If you know of somebody who does not have an FSM1.com account, now is the best time to get them to start one. Refer a friend to open an FSM1 account from the 9th to the 26th of January and you will stand to receive 3,000 rewards points for each friend, up to a maximum of 15,000 points. Do note that if your FSM1 account was opened directly on our main website without submitting the form below, you will not be eligible for this promotion. All this coming up later this afternoon starting from 1 p.m. We'll see you later. Welcome back, everyone, and I hope you've all managed to get your lunch and are settled in for more exciting ideas of what and where to invest in 2021. As you can see, with this 3D torchlight and compass here, it represents our theme for the day. Let FSM1.com shine a light on the areas of opportunities and point you in the right direction of where to invest in 2021. Before our next presentation on the Singapore market, we'd like to highlight several promotions you can look forward to. First is a unit trust promotion. Release $10 bonus units for every $10,000 invested in any of the 21 unit trusts from our top 5 markets and 4 favorite themes. Which are these 21 funds? Head over to fsm1.com to find out. This promotion lasts from 9th to 31st of January. For a 6-month period from 8th of February to 2021 to 31st of July 2021, enjoy a 0% processing fee when you transact via a regular savings plan. There's no better time to get started with ETF RSP. Open an FSM1.com account in just 5 minutes today via MyInfo. From the 9th of January to the 26th of January, open a new FSM1 account to receive 3,000 rewards points. To enjoy this promotion, you must click on the Promotions tab on the black menu bar and complete the form via the Account Opening Promotion form and click on the Submit and Proceed to Account Opening button to proceed to the FSM account opening page. If you know of somebody who does not have an FSM1.com account, now is the best time to get them to start one. Refer a friend to open an FSM1 account from the 9th to the 26th of January and you will stand to receive 3,000 rewards points for each friend, up to a maximum of 15,000 points. Do note that if your FSM1 account was opened directly on our main website without submitting the form below, you will not be eligible for this promotion. Coming up later, you can also take part in the daily quiz, where we will be giving away $100 worth of FSM1 multi-currency cash account credits to 3 lucky winners with the fastest and most correct answers. Accumulate chances throughout the event for our lucky draw happening on the 21st of January and stand to win up to $1,000 worth of FSM1 Auto Sweep account credits. To be eligible, head to Event Live via the link in the confirmation email you received when you registered for this event. Get 1 chance per day by logging on each event day from the 9th to the 21st of January 2021. You can also get 1 chance per day by participating in the daily quiz sessions or by completing and submitting the survey on the 21st of January 2021. You can also get your one chance by visiting our partners pages. They are Nico AM, Schroders, UOB AM, and Allianz Global Investors. Lastly, you can also get your chance by sharing this event on your social media through the social media buttons on the footer. Remember to access Event Live using the same name or nickname and email address each day so that you can accumulate as many chances as possible. If you have any questions regarding the presentations today, you can ask them in the Q&A section by clicking on the Ask Question button. We'll have our speakers to answer the questions later on today. And now for our next presentation. While Singapore's equity market has been lagging behind its global peers for the most part of 2020, it has caught up in recent times. Have the winds of change finally descended upon Singapore's equity market? Will 2021 be the year for Singapore equities to finally shine? Join us for a discussion with portfolio managers, Mr. Kenneth Tang, Senior Portfolio Manager, Nikko Asset Management. Mr. Terence Wong, CEO and Executive Director, Azure Capital. Moderating this session will be Mr. Yeo Wei Ren, Manager, Stocks and ETFs Research, IFAS Singapore.
And thank you to everyone for joining us here today at What and Where to Invest 2021. And today, for today's panel discussion, we are going to talk about something that is close to all of our hearts. We're going to talk about our home market, and that's Singapore. So Singapore's equity market is in quite an interesting spot. Its performance hasn't been as well as its other global peers. And not just in 2020, but we have also seen that in the past few years as well. And I think 2019 was a very good example. It was supposed to be a good year for equity markets in general, but Singapore's equity market has surprisingly been lagging behind its global peers. So I'd like to start off my panel discussion today by talking a little bit about Singapore's historical performance. And my first question to our panelists today is, Kenneth, Terence, what do you think are some of the key reasons why the Straits Times Index has underperformed its global peers for the past few years? And maybe I'll first invite Kenneth to take this question.
Well, thank you, Wei Ren. I think it's a great question to start this webinar. One wise investor once said that in order to know the future, you have to understand your past. So let's start with understanding why Singapore gave you a return of minus 8 to 9% last year, when every global market or generally returned something in the region of 16 to 17%. And when you look at Singapore's reason for underperformance, I would like to just highlight a couple of reasons why Singapore underperformed. The first is really Singapore is a value market. And as you can see in the chart above us, you can actually see that return on equities for Singapore has actually been on the downtrend for the last 10 years. And with lower return on equity, typically that's really a signal of obviously weaker economic performance and weaker corporate earnings performance. And that has actually led to the derating of Singapore in many regards. The second reason why Singapore would have underperformed last year is actually its demography. And we all know that the Singapore market is actually quite well concentrated in banks, property and telecommunications, which makes up almost 70 to 80% of the market. And last year wasn't a very good year for financials, given the focus away from value and into growth. So when you compare Singapore with the other markets, such as Asia and the global markets, you will find that there's actually a very different sector demography that has actually led to reasons why Singapore has underperformed.
I think if you look at the general composition of STI, just to take it a little bit further from Kenneth, it's almost 50 to 60% of it, they're dividend yielding companies. There's like the banks, like you mentioned, the telcos, and of course, who can forget the REITs, right?
Right.
And then when SPH got booted out in June, the next 5 on the reserve list, they're all REITs. Everybody was lapping onto the the REIT story, the dividend story, and we're heavily concentrated on that part. But it's not to say that our markets didn't perform, because there are many companies, like say the glove makers, for example. They're up like 6 times, 8 times. We're not talking 6 to 8%, we're talking 6 to 8 times. But they are not part of the STI, unfortunately, right? And some of the smaller tech companies, the manufacturers, they're also up like 30, 50, 60%. But again, they're not being represented on the STI.
So it seems like the STI is like what Kenneth has mentioned just now. It is, a lot of them are value stocks. But in the past few months, actually with positive developments on the vaccine and also Singapore's economy opening up, value stocks have actually started to gain traction. And this has been reflected in the performance of the Straits Times Index. So I think my next question to you guys is, do you think this rally can sustain itself, or is it just a false dawn? Maybe Kenneth, you'd like to take it away?
I think, again, when you look at with the perspective of of history, you can understand then what it takes for Singapore to perform is for value to come back and for returns to improve. And I think the report card is quite good. When you look at the broader economy, we are actually on the road to recovery. Just a general chart that shows basically some indicators on transportation movements as well as retail activity. We are quite close to what we call normalization. And that is actually a good verdict for Singapore coming out from the economy downturn that we saw last year. And if that continues, I believe that will actually set the scene for the markets to perform better.
Terence,
I actually agree. I totally agree with Kenneth. You look at the economy for this year. In fact, for the first time in the past decade, Singapore is actually going to outperform, in fact, be one of the best in the region at over 5%. So very, very happy. And I believe that is going to drive the markets. Of course, if you're saying whether this rally will just like go all the way like to June, December, very unlikely. Of course, there are certain things there are certain humps along the way. And don't forget, if you look at just Singapore alone, we are still about 20% away from our all-time peak set in October 2007. That time was over 3,900 points. We're a distance away, whereas a lot of the other indices globally have already hit their all-time highs. And like say US, for example, NASDAQ, S&P, they hit record after record. And the propensity for them to falter is there. And if they were to do so, there could be, some short-term kind of like we fall in sympathy together with them. But I think if you are looking at the longer-term picture, like for this year, there's really a lot to be optimistic about.
I think I just want to add and just affirm what Terence has just said. I mean, when you look at really relative valuations, Singapore is cheap. And we all know this, but this is just, again, an example of how much Singapore has lagged the region. And we do feel that as the global economy starts to reverse more positively, our value is going to come back in terms of performance, and that could actually help Singapore do better. So we actually are quite optimistic for the prospect for Singapore in 2021.
But whether or not value stocks can actually perform in 2021 will be dependent on whether Singapore's economy can actually recover in 2021. So actually at this point, I just want to take a step back from this discussion on equity markets to look at Singapore's economic outlook, because Singapore is an export-oriented economy, and a lot of our economic activities, we're dependent on external demand. So maybe Terence, my question to you then is, what do you think is the global outlook, economic outlook for 2021, and what does this imply for Singapore's economy this year?
Well, I don't really have to be economist to answer this question, even though I study economics. Not a great student, but I study economics. But you see, like last year was so terrible, right? That this year is bound to be better than last year. And last year, most of the countries like globally were locked down in the second quarter. We've seen like quarter-on-quarter improvements, but on a year-on-year basis, I'm quite sure that we're going to do decently well. And Singapore being a small open economy, we are going to be a beneficiary of this improvement in global economy. Like I mentioned just now, Singapore, we are likely, because we are a small open economy also, we are likely going to outperform the rest of the region. So this year should be a good year for us.
Kenneth, is that also a view that you
I
hold?
agree with Terence. When you really look at the fabric of Singapore's economy, exports account for close to about 200% of GDP. So we are very much an export-oriented economy. And one of the things that maybe investors have not paid as much attention to is despite last year's COVID impact on the economy, the one sector that got really hurt very badly was the service sector. The manufacturing sector actually did very well. Again, when I look back at the last 25 years, again, a chart that I could perhaps help illustrate this better, is that whenever you see Singapore exports perform well, typically it's a good harbinger of better returns to come for Singapore. And we saw a very good recovery for Singapore exports actually from last year. And that actually helped to hold up Singapore's economy much better than what people foresaw. And when you look at really the past 5 down cycles, most of that has actually been preempted really by a recovery in exports. I actually find quite interesting that when you look back, I do remember, again, when Terence talks about history, in 2003, there was a very similar pandemic, maybe less serious than today, called SARS. And we actually saw the STI gain significantly after economic exports or electronic exports bottomed and actually performed very well. So in some way, it's a bit deja vu. There are different aspects here again, but I would believe that this is actually another good indicator of equity performance that we can expect in 2021.
Back in 2003, I remember vividly there were a host of contract manufacturers, tech companies. Okay, they're not really tech, but the contract manufacturers that surged up. Many of them like doubled up, grew 150% because interest returned, and there was real business coming through. The orders started to rack up back in 2003. I remember that the real turnaround was in the second half after May, when equity markets started to rocket. That's when they started to have all these improvements in their orders.
Yeah, but the sad thing is some of these technology companies have been either privatized and taken over. And I think that's really true because I do remember 2003 also was a good time for industrial stocks. So it was not just technology companies. I believe there was the JITs, the Jurong Techs, but there was also the broader economy such as the Costco holdings, the Hong Leong Asias, where it was really a good fabric of the industrial economy. And a lot of the industrial stocks have actually benefited from that period of recovery. So interestingly, this year or last year, we did see a lot better performance. I think the names that Terence mentioned, many of these stocks were actually very strong performers and gave you positive return, even though the STI returned negatively.
But the fact is that if you look at the makeup of the STI, I think no discussion on Singapore's equity market will ever be complete if we don't talk about the biggest stocks that is inside the index, and that is the 3 local banks in Singapore right now. They make up close to about 40% of the STI. So in order for STI to do well, the banks, first and foremost, they have to do well in 2021.
That's right.
So I'd like to now move on into perhaps more sector-specific stuff, and I talk about the banking sector, and maybe I'll get Terence to come in. So Terence, how do you see the banking sector outlook for Singapore in 2021?
Stocks are typically forward-looking, and I think that investors are confident of this year, and therefore they started to play up the bank stocks. That's one of the first, they're the front runners. They've gone up about 10%. I think that there's still some room to grow, given that but they may take a little bit of a breather right now. I'm not too sure whether they're going to outperform the market because, like I said, they are front runners. They've gone up already. A few things that they are actually enjoying. One is the NIMs, I think, have become a lot more stable. And last year there were a lot of provisions being made in the first 9 months, and it may possibly be over providing. So that's another, I think, another point that they actually benefit from. Fee income is also likely going to increase. Currently, I believe the banks are trading 1 to 1.1 times price to book. It's still slightly below the average of about 1.2, 1.3 times.
Terence?
But of course, the thing that I guess people may potentially be worried about is that, sometime in the near future, the digital banks will be launching that product. And in Hong Kong, it's very, very bruising. You can see that some of these digital banks actually come with 6% interest rates just to draw the deposits. But that said, I think that our three banks, they are digital banks. They were very forward-looking, and they seem like, they have this in the bag. So really, it is for the new debutants, the digital banks, to really up the game.
Terence, I think you mentioned about net interest margins, which is quite an interesting area to focus on. Now, my follow-up question on your answer then will be, with interest rates remaining at such low levels, do you think there is scope for NIMs to rebound meaningfully for the banks this year?
Okay, I don't think that they'll rebound. Kenneth, you probably want to I don't know different, but I don't think it's going to rebound. It's probably going to stick around. But because expectations over the last 2-3 quarters were so low, like I'm saying, it's stabilizing is actually quite a good thing for the banks. Yeah.
Okay.
But for me, even though I think that the banks will do decent, it's not likely to be a sector that I'm going to outperform or like that I'm actually going to be overweight on. Yeah.
Okay. What about you, Kenneth?
I would like to chime in. I think two things matter a lot for the banking sector. The first is really the credit cycle and how provisions have actually been front-loaded. And I do agree with Terence that we have probably done a lot more prudent way of actually addressing that credit cycle. I think the other thing, which I think you touched on really importantly, is really the direction of the yield curve. And banks basically make most money from a steepening yield curve. And I think we have seen a little bit of that happen in the last week, and that's really why the banks have performed very well. But to assume a very strong road to recovery where yields steepen and basically get back to levels that they were, I think is going to be quite difficult. I would think that it will probably be more driven for the banks, in my opinion, to be, again, the ways that they can actually deliver growth in a low yield environment. And I think some of the banks that are looking interesting for us are those that have tapped onto, obviously, fee income as a lot more as compared to their traditional lending income. And I think some of the banks have actually done better in the area of wealth management, the way of digitization, and looking at how capital markets have actually benefited them. So that is where I think we could see some performance within the banking sector in the area of the fee income.
I think besides the banking sector, I think another sector that has been affected by COVID this year is actually the REIT sector. And I think for most of our viewers right now, I think for them, if they are income investors, there's a very good chance that they have S-REITs inside their portfolio. So they'll be very interested to know what is your outlook for S-REITs in 2021. So maybe, Kenneth, I'll get you to share your views first.
Thank you for the question again. I think we have continued to be strong advocates of dividend investing. Dividends is a core part and a core fabric of the Singapore stock market. We have one of the highest dividend yields in the region, as you can see again from the chart behind us. Singapore yields are attractive compared to the regional yields in the various markets. And one of the things that I think is important for dividend investing, especially this year, is really coming back to finding dividend growth. We should not be too focused on the absolute yield, but on companies that are able to deliver dividend growth in a time where probably growth is actually quite scarce. And within the S-REIT environment that you mentioned, I believe there are certain sectors that are still offering you good growth prospects, such as the industrial REITs, the logistics REITs, as well as selective retail REITs, which we think are benefiting from growth recovery from the reopening of the economy. So there are pockets of areas where we think performance can come from the S-REITs, and we actually like these sectors.
Kenneth, you mentioned that logistics and industrials are some of the areas that you are positive on, but I think most of the S-REITs within those sectors, they have actually rallied quite strongly. And I look at REITs like Capital TC REIT, for instance, it has done exceptionally well in 2020. So given that share prices have run up so fast, do you think it is still an opportunity for investors to capitalize on?
I believe some of these REITs have been priced for a lot of the delivery of that growth, but I believe that they have also continued to exhibit really good sustainable opportunities to continue to build on that growth. So some of these companies have been able to make acquisitions to really improve their growth prospects, and there is also greater opportunity because of COVID that will come from consolidation and perhaps more M&A in this sector. So I think these are some of the internal opportunities that we see in S-REITs, where we think that more stock-specific drivers could actually determine better performance. So it's not, again, we are stock pickers. We are not taking a blanket approach in owning sectors for the sake of those propositions, but focusing on really companies that can outperform in this time.
But I think within the S-REITs sector, there are also certain segments that are being impacted by COVID-19. So retail REITs, office REITs, for example, they are being disrupted by COVID-19. So I think I will pose the next question to Terence. So Terence, what do you think about the prospects of office and retail REITs? Is that an area that investors should stay away from, or do you think there are still opportunities within?
Well, I think within the REIT space, right, since so many of you are into REITs right now, there's really the guys that, you know, are a little bit more defensive, and then there are those that can ride on the recovery. The industrials will probably fall in that, and a lot of people are lapping onto the industrials, and therefore you can see that the yields have been depressed beyond the average, right? Whereas the rest of them, I think they're still falling within that band, whether you're talking about office or retail. And I think that I agree with Kenneth. I'm not so much into subsector kind of like picking. Last year was very, very intuitive for me. I mean, like, I think that, you know, the retail guys are going to go, hospitality is very, very tough, right? And therefore, I think that industrials will be one area to huddle in, like basically be a safe haven. But right now, if I take the view that, you know, things are going to improve, I believe that there will be selective stocks within the two spaces that you mentioned, whether in office or retail. Both, of course, they are hit. I mean, in terms of like the growth prospects, of course, there are headwinds, but then there are still, I think, picks within these two sectors that you can look at, especially those that can, you know, like right above the rest and go back to the normal growth rate where they were in 2018, 2019. If they can surpass that, you know, and look beyond the 2020 harsh numbers, I think these are some of the companies or some of the REITs that you can think of investing in.
I think one of the most interesting, or rather one of the stocks that investors has been buying recently is travel-related stocks, especially with positive news on vaccines. So a couple of travel-related stocks within the STI, they have also rallied as well. So Kenneth, maybe could you just share with us your thoughts on this rally, and can travel-related stocks potentially do well in 2021?
Yeah, I think that's an interesting question. When you really look at the service industry, which really encompasses travel, that has been a really sector that has suffered the worst. In fact, last year, when you look at the GDP numbers of close to -6%, almost entirely really came from the service sector. The manufacturing sector, as I mentioned, was really a positive driver as compared to the service sector. We are in recovery right now, but my view is that I think the service sector will remain challenged because I think normalization for travel will take probably a longer period of time, and for the full resumption of tourism, of travel-related services, we think will actually take a longer period of time. So I'm of the view that service sector is going to be probably a more challenged sector in 2021, and we think that that's going to be the case. That said, when you look at service sector as a whole, it's actually quite interesting when you look at the fabric of Singapore, because again, when we talk about stocks, and we are stock pickers, we want to focus on companies that are also restructuring despite the pandemic. So I think COVID has done one good thing, which is really enhance innovation and help companies recalibrate their growth and to be able to focus on sectors of new growth. Take, for example, a company like SATS. SATS is basically an airline catering business, but I think through COVID, we have seen SATS actually diversify a lot more into areas that are in non-aviation food. So you have food services, and you have also other areas of growth. And they have also been able to harness their capability to do freight transportation for vaccines, for the healthcare products, and e-commerce. So these are some areas that we think make some of the service stocks interesting, as opposed to taking a view on buying the full recovery for the sector.
I think our discussion on the Singapore's equity market will probably go on and on, but unfortunately, we only have about 20 minutes to talk about Singapore's market. So I'll just ask both panelists one last question. Kenneth and Terence, how are you guys positioning your portfolios for investors in 2021? Maybe Terence, you would like to share first?
Well, I love the Singapore market and I love small and mid caps, right? But last year, especially during crisis, I always tell people you don't have to be too creative. You can just bank on you can just look at the large guys, you can look at the STI components, you don't have to take too much risk. But right now, given that like you're a lot more positive, I'm also like shifting a little bit. I still think that within the big cap space, the properties are worth looking at. They are trading about 50% discount to RNAV, some selected REITs. And then if you want to be a little bit more aggressive, you can play into the Keppel, Sembcorp Marine kind of, the takeover. So Sembcorp Marine, I think, looks interesting to me, though the risk is slightly higher. Reserve, some ammunition, I believe, for the small and mid caps, because I think that they are going to look very, very interesting. And there are very good stories to tell. And many of these guys are trading at very, very palatable valuations.
How about you, Kenneth?
Well, we like industrials and we like technology. I think these technology particularly has been a big performer of last year. And last year, if I recall, when we look at the best way to describe 2020 was really resilience. If you focus on business models or companies that can deliver defensive growth and resilience, you would have outperformed. And I think technology provided that resilience and in fact gave you additional growth as well. So when we go into 2021, what do we buy or what do we like? I think it goes back to the traditional view of looking at what's sustainable growth and what is companies that are able to move from resilience into recovery. And I think there are still opportunities in technology that can offer you that. I think industrials is a more interesting sector because industrials was actually quite badly hurt last year. And we think that there's a lot of interesting bottom-up opportunities happening in industrials. So if I look at one final chart that I can also share is really the direction of corporate earnings. Follow where corporate earnings move and the STI will follow. And this is really a rule of thumb when you look at corporate earnings. Where do we find sustainable growth and where is growth inflecting? Typically, that's where you want to invest in because ultimately we are in a very low growth environment and growth is actually very scarce. So we think that the franchises that can give you sustainable growth will continue to outperform in 2021.
All right, thank you so much for all the inputs today. And ladies and gentlemen, we have actually come to the end of our panel discussion. And I'd like to take this opportunity to thank Kenneth and Terence once again for taking time to join us on this panel discussion. So we still have an exciting lineup of programs for you, so please continue to stay with us.
Thank you, gentlemen. Up next, we have Mr. Ken Wong, Asia Equity Portfolio Specialist from East Spring Investments, who will share with us where the diverse investment opportunities are in Asia and how to invest in the new world in the new year.
Wonderful break, sort of during the past couple of weeks, and everybody's full speed ahead now as we head into 2021. And with that said, what I want to do is, talk a little bit more about specifically, where are some of the opportunities? Specifically, where are, opportunities where we can see there will be good investment opportunities for investors. So with that, why don't we start into our presentation in which, we can see specifically, how markets have performed. So I think we're going to come up with the presentation here. Hold on for 1 second. There we go. Okay, so specifically, when we look at asset prices around the world, what we can see is that 2020, despite the fact that we had, obviously unfortunate events surrounding COVID, most markets actually ended up the year ahead. If we look at stock markets all around the world, they were mostly up. The only exception was predominantly when you look at oil prices, despite the fact that they fell down quite a bit. For the full year, they were only down about 20%. And then you look at, a couple of equity markets were down slightly, but they were only down low single digits. If you look at on the right-hand side, whether it be a fixed income or stocks in general, 2020 actually ended up to be a fairly positive year for investors. If I can turn your attention now to the next slide, please. In particular, what we saw during the fourth quarter back in 2020 was that when there was positive news around a vaccine, this was actually a very positive boost for cyclical stocks. For a lot of investors within the ASEAN markets, what they saw, especially during the first 3 quarters of 2020, was markets very much corrected, performed very poorly. But then during the fourth quarter, we saw how a lot of cyclical stocks within the ASEAN markets did a 180 and they performed very well. And so as a result, because of news of a vaccine, we saw markets perform very well. So as we head into 2021, our belief is that, as we get more and more positive news around, let's say, the rollout of the COVID vaccine, that should actually continue to bode well for cyclical stocks. If I can turn your attention to the next slide, please. So in the U.S., we all know this week there was a lot of concerns of what happened in the capital of the U.S. But with that said, what happens now after Biden victory? Well, there's a few key points that we think should be around or should be key in the coming months and quarters ahead, which is number one, Biden's definitely going to support free trade agreement and promote the Pacific Partnership Agreement. Repair relationships with traditional allies. Policy towards China will moderate slightly, but for a lot of investors or for a lot of people who feel that Biden's really going to be entirely opposite with what Trump has done with China, we don't feel that's the case. We feel definitely because we are now living in the new norm that U.S. and China will still have various amounts of confrontation, but maybe the amount and the level of confrontation might be a bit lower than what we had from before. Previously we talked about a potential divided House. Now, with the Democrats and with specifically, taking control over specifically the Senate, what we're now going to see is that both the Democrats has the ability to control both the House as well as the Senate. But despite the fact that we don't have a divided House, a divided Congress, still very much live in a divided world in the U.S. where half of the population or close to it, or at least 70 million people, actually voted for Trump. Also with Biden, we feel that he's going to alleviate some of the regional geopolitical crisis that we're seeing and potentially reduce some of the market volatility that we're seeing in the marketplace, which is very important. And finally, we think that the U.S. dollar will continue to weaken as we head into 2021, because the fact is that U.S. is running a very big fiscal deficit, and obviously that could create a bit more uncertainty for the U.S., especially with how they're going to be handling this large deficit amount going forward. If I could turn your attention to the next slide, please. Now, when we look at the elections, what tends to happen in Asia is that Asia tends to consolidate before the U.S. elections. But then, after the elections, basically, and historically over the past 40, 50 years, what we've seen is that Asian equity markets tend to rise over the next 6 to 12 months after, the selection of a new U.S. president. And with that said, what normally tends to happen is that during the second year, markets tend to be somewhat flat or somewhat down. But then in the third year, as well as in the fourth year, we then start to see actually Asian equity markets starting to perform again. Next slide, please. And if we look at valuations, across the board, whether be it, here in Asia, in the EM space, or in developed market space, what we actually see is that Asian equity markets right now are trading much more cheaper and much more attractive as compared to most developed markets. With some of the cheapest markets here in Asia, like South Korea, Singapore, China, Malaysia, Hong Kong, and so forth, there is a margin of safety when it comes to investing. And so that's why a lot of times when I get asked this question where, is this a good time to invest in Asia? Or, given the fact that markets actually ended up to be positive in 2020, is it a good time to still continue to invest? And my answer is still, given how valuations are still very attractive, the answer is definitely yes. We still think there's a lot of opportunities to invest for, especially here in Asia, for investors. Next slide, please. Now, when we talk about investing and when we talk about valuations, one of the key things that we look at as investors is we really focus on earnings and corporate earnings growth in the coming years. Because the fact is that, valuations can go up and down, but what's going to be key is how well can some of these countries perform when it comes to their corporate earnings growth. Now, we know for a fact that 2020 was a fairly difficult year because obviously with COVID, pretty much all the countries had negative corporate earnings growth, with the exception of China, Taiwan, and to some extent Australia. Most other corporates most other countries around the world actually had a decline in their corporate earnings growth. But for 2021 and also for 2022, the expectation is that earnings growth is going to be very strong, and we're going to see a very strong cyclical rebound, especially with positive news over COVID vaccines. Now, obviously, what's the downside potential? The downside potential is, we could potentially, let's say if the rollout of the COVID vaccine takes longer, to actually, roll out, then specifically, these earnings growth and these earnings recovery might stall and might take a little bit longer. But right now, if we look at expectations, the markets right now still do believe that obviously the first quarters might still be a little bit difficult. But as we approach the end of the first half and as we approach the second half of 2021, that earnings growth will definitely start to recover. Next slide, please. And of course, the one other key reason why we really do like Asia is the fact that the fundamentals are very accommodative and very supportive for investing in Asia. When we talk about, GDP growth or economic growth and the forecast for the next couple of years, where is economic growth going to be? It's predominantly going to be here in Asia. And also, if we look at the current account deficits, looking at, which particular countries or regions have a fairly strong current account balance and the surplus, well, it's also here in Asia. So that's why when we look at the fundamentals itself, Asia really do seem to be a very good choice when it comes to investing. Next slide, please. And of course, when it comes to this recovery, we can't, we can't forget that, China is definitely leading this recovery. But in addition to China, North Asia, places like South Korea, Taiwan, these countries are also benefiting, from tech-related demand. On the left-hand side, you can see this is the Asian Manufacturing PMI Index. And what we can see is that actually since the lows that we saw back in April and May period, we've actually seen how, the PMI index, the manufacturing index here in Asia have actually trended in a very positive directions. Most countries are now seeing, positive growth again when it comes to their PMIs, and they're seeing a expansion instead of contraction. And also at the same time, when we look at the chart on the right-hand side, this shows us exports. And also, exports are also recovering. And a main reason for this is that, despite of, some of the declines that we had seen earlier back in 2020, because of the strong demand for tech-related products, we have definitely started to see, more and more exports recovery. And at the same time, that's also one of the reasons why you're seeing, export numbers going up and current account balances growing again for Asian countries. Next slide, please. Now, the other thing to think about here in China is the fact that this year we're going to have, another fifth plenum. Basically, this is going to be the 14th five-year plan. And basically, the 14th five-year plan, what we're going to be seeing is that, and again, with news already of what's to expect, is that China is going to definitely have more self-reliance on tech and also to focus on their domestic demand. As you can see here with this chart, China is really lagging behind. If you look at China's consumption as a percentage of GDP, it's still hovering roughly around 53, 54%. This is significantly lower than what we see in most other countries. For instance, in the US or places like Japan, in the UK and so forth, they're more closer to 75, 80%, in which consumption is a percentage of GDP. So the only way China will be able to push and bump up, consumption is really to have a much more self-reliance on technology and to really promote more and more people to consume. And we expect that over the next 5 years, this is what you're going to have. China has a growing middle class where over the next coming decade, China's going to see an extra 300 plus million people entering into the middle class. So with that said, we have a very strong belief that consumption is going to be a very key story for China in the coming years ahead. Next slide, please. And if we look at the currency as well, what we need to think about here is that, why do we believe that the US dollar will and, should actually weaken further? Now, there's a lot of talks that, hey, if you think about it, the US dollar now is, sort of hovering below 90 again. And, it reached its highs of over 100 just last year. Now, don't forget a few things here. Back during the Asian financial crisis, and also around 2011, we actually saw the US dollar index fall to around 72 to 73. So even at this current level right now of 90, we're still nowhere near the lows that we saw, just a little bit over a decade ago. And of course, with a rising fiscal deficit in the US, we feel actually that the dollar should actually continue to weaken as a result. And of course, if we look at Asian currencies, Asian currencies now and the way that they move is, they're very much more correlated, and they move in a very similar direction as the renminbi. So as the renminbi gets stronger and stronger, we feel that the Asian currency index and a lot of the other Asian currencies should also move in a similar direction, because over the past few years, we've been seeing a very similar trend in terms of that type of currency movements. Next slide, please. And of course, we can't forget about the ASEAN markets, right? Some of the previous discussions, and I think a couple of the previous speakers on the panel talked about Singapore, but when we talk about it, it's not just about Singapore, right? Singapore definitely, we see that there's a lot of opportunities, but even in Malaysia, Philippines, Indonesia, and even Thailand, when we look at the valuations versus its 10-year history, actually ASEAN markets right now are trading very attractive. Basically, when you look at this particular chart here in this table here, five of the 6 countries, specifically in this table here in Asia, are actually the ASEAN countries, which are trading the most attractive relative to their history. So, obviously, when we talk about trying to find, sort of opportunities and trying to maybe find some of the underperformers where we might be able to, sort of catch them on the way up, it will be a lot of the ASEAN markets. So last year definitely was a year where, a lot of people forgot about the ASEAN markets. People were much more focused on North Asia. But we feel, as the economy starts to open up again, and hopefully, with the working COVID vaccine, that people will start to invest in the underperforming markets. And in that case, ASEAN markets do have a very good opportunity. Next slide, please. Now, I talked a lot about equity markets, but I also want to very quickly talk about bonds as well, because if we look at, sort of where opportunities are in a current low interest rate environment, we actually think that, Asian bonds, whether it be Asian high yield bonds, Asian US dollar bonds, or Asian local bonds, these actually have the best risk adjusted returns for investors. So when we look at, where should investors invest in the bond market if they want to have the highest risk-adjusted type of returns? Well, it's definitely within the Asian bond markets, because they're much more favorable as compared to any of the other bond markets that's out there. Next slide, please. Now, I want to focus a little bit more on the Asian high yield bond space. Now, if you ask me right now, why do we have a very strong belief in Asian high yield bonds? Well, look at it this way. Their average yields right now is roughly about 7.9%. And of course, we know when we put our money in the bank, the yields are going to be very low. And of course, if we look at specifically some of these other markets, the yields are also not that high. And if we compare the Asian high yields and US high yields, the average yield for Asian high yields is 7.9%, while US high yields are only 4.7%. But did you know, actually over the past 10 years, the amount of defaults that we have seen amongst Asian high yield bonds is actually significantly lower than what we saw in the US high yield space. So not only does Asian high yield bonds create and provide a higher yield, but the amount of defaults that we have seen over the past 10 years have also been significantly less than what we've seen in the US high yield bond space. Next slide, please. And the Asian local currency bonds. And when we talk about Asian local currency bonds and where are some of the advantages, well, we just look at the interest rate differential. We compare the average Asian 10-year bond, compare that with the US 10-year treasury bond. Over the past year, the amount of difference between the yields of a US 10-year treasury as well as compared to an average Asian 10-year bond is roughly about 2.5%. So for investor, why wouldn't you want to be sort of compensated, specifically a little bit more to invest in the Asian local currency bonds? Because the fact is that when you look at, what's more appealing and what looks more attractive, it's definitely, Asian local bonds and Asian local currency bonds when you compare that with the US, because you get an extra 2.5% in yield on an average, on a per annum basis. Next slide, please. I think we're waiting for the next slide to come. I think, there we go. So again, if we look at the Asian local currency bonds, you can see here on this chart that, across the board, most countries are actually providing a fairly good yield. In places like Indonesia and India, the yields are, sort of hovering around 6%. China is hovering a little bit over 3%, and so on. So you can see that a lot of and this is one of the key reasons why the yields on Asian local currency bonds are fairly attractive, because you have countries like Indonesia, India, and China, and even sort of Thailand and Malaysia and so forth, where the yields are actually fairly solid, above 3%. So this is actually one of the key reasons why the average 10-year bonds, sort of for here in Asia, as compared to the US, to Germany or Japan, is significantly higher. Next slide, please. And of course, if we look at the Singapore bond market, the thing that we have to realize is that the Singapore bond market provides relative stability during various periods of volatility. So this chart here, you can see that across a lot of different periods, where we've seen a lot of different volatilities, whether it be it from recent COVID, from trade wars, to China fears, taper tantrum, GFC, past Fed cycle rate hikes. You can see that pretty much across the board, the Singapore bond market has been very stable and provides a lot of stability for investors when markets are volatile. And that's what you want, right? Because especially for investors who do not want to take a lot of risk when it comes to investing, obviously for them, investing in Sing bonds would be a very good opportunity for them. Next slide, please. And finally, before I wrap things up, now we all know about China, and we all know about where the prospects are for China. But in addition to China, we think that there's a lot of opportunities in the very diversified Asia, in particular when you look at a lot of these different countries. Taiwan, tech and green energy is definitely playing a key catalyst. South Korea, shift to hydrogen-based economy, shipbuilders, again, tech still continues to be a key theme for South Korea. India, specifically, we're looking at e-commerce boom that's likely to happen, and so forth. And so what you can expect to see is that, in every single country, there's a lot of opportunities when it comes to, sort of various policies and for their economies and for their corporates to grow in the near distant future. And that's why we think that in 2021, investors should not forget about Asia, especially with a weakening of the US dollar, and the US dollar weakens further, we expect actually for more capital to come and flow into Asia. And if that's the case, a lot of these laggards and a lot of these markets here in Asia will definitely see a lot of capital inflows as a result of a reversal and the weakness of the US dollar. And the last slide, please. So, what are the strategies that can be considered, after hearing my talk today? Well, here at Eastspring, there's a few different strategies that we can offer for investors. For number one, we do for investors who want to invest in, let's say, the underperforming ASEAN stock market. Well, they can invest in our Singapore ASEAN equity fund. For investors, as I alluded to earlier, who wants to, try to achieve a higher yield in such a low interest rate environment right now, well, the investor can invest on the right-hand side, our Asian high yield bond fund, which provides a very good yield. And obviously, for investors who don't like to have a low yield, but, tend to be still, fairly, investing in bonds, opportunity is definitely there by investing in the Asian high yield bond fund. And again, for investors who would tend to be, a lot more conservative, but at the same time, do not want to see a lot of volatility within their investments, well, we think that investing in Singapore Select Bond Fund actually makes a lot of sense for investors. So right now, while 2021, there seems to be hopes of, positive news from whether it be a COVID vaccine or now with Biden becoming a new president and hopefully inciting less volatility and potentially having more certainty back into the markets, we think that there's definitely going to be a lot of good opportunities for investors to invest. And with that, I wish everyone a very prosperous 2021 and having very good returns and investments for the year ahead. And thank you very much.
Thank you, Ken. COVID-19, as much pain and disruption it has brought to our daily lives, has also become an unexpected catalyst for the digital economy. Join us as we discuss the pandemic's long-term impact on the industry and the companies you should pay attention to in 2021. Our next speaker is Mr. Tan De-jun, Senior Equity Analyst, Stocks and ETFs Research, IFAS Singapore. De-jun is an equity analyst with the research team at IFAS, providing analysis and research coverage on both stocks and ETFs listed on the Singapore, Hong Kong, and the US markets. The global technology and semiconductor sectors are De-jun's areas of expertise. De-jun has also contributed his views to the local media, including Business Times, Lianhe Zaobao, and 96.3 FM. De-jun, please.
Good afternoon, everyone, and welcome again to What and Where to Invest 2021. My name is De-jun, and I'm an equity analyst at FSM1. And for this segment, I'll be sharing with you about the digital economy, how COVID-19 has affected it, and more importantly, the investment opportunities that we see over the next couple of years. So without further ado, let's begin. So the world as we know it is on the cusp of a new technological revolution known as the Fourth Industrial Revolution. So this marks a turning point in human history where the widespread use of digital technology such as the internet is blurring the lines between the physical and the digital world, changing the way we live, work, and interact with each other. So unlike the previous three industrial revolutions, digital technologies today are evolving at such breakneck speeds that individuals and businesses are finding it hard to keep up with the changes at times. And those who fall behind run the risk of being rendered obsolete. So the rapid digital transformations happening across all industries and sectors will bring about many new investment opportunities, especially among the companies that are able to adapt to the changes quickly. And as the world we live in becomes increasingly digitalized, the digital economy will likely become an integral part of every investor's portfolio. So what exactly is the digital economy? So the digital economy can be defined as a massive web of interconnected shareholders and supply chains covering all digital products and services that are enabled by the internet and other digital technologies. So while there is a lack of an industry classification system due to its complex nature, the digital economy can be broadly categorized into the following 8 segments. So let's talk about some of them. So e-commerce, for instance, is a segment that I believe most of us are already familiar with. Here, e-commerce has fundamentally transformed the way people shop for physical goods, with online retailers such as Amazon and Alibaba having an outsized impact on the broader retail market. And as more people choose to shop online, brick and mortar retailers are forced to reinvent themselves for the digital era. So cloud services is another fast-growing segment within the digital economy. So here, cloud service providers provide the hardware and software components that are needed to support the data storage, computing, and networking requirements of a business. So as companies migrate a greater portion of their workloads onto the cloud computing industry is set to see explosive growth ahead. So lastly, let's talk a bit about digital advertising. So because consumers are spending more and more time on the internet compared to traditional media, engaging with them is not the same as before. So for firms who are looking to advertise themselves, digital advertising is almost always a necessity in order to maintain a strong online presence. So collectively, these 8 segments of the digital economy make up roughly $9.5 trillion US dollars. That is roughly 10% of the world's GDP. So if you were to think of the digital economy as a national economy, it would be actually the 3rd largest in the world, behind only US and China. So taking a look at the changes in the world's largest companies across time gives us a sense of how quickly the digital economy has developed over the years. So compared to a decade ago when only 2 of the top 5 companies are considered digital economy stocks, every single one of the top 5 largest companies today belong to the digital economy. Looking ahead, we think that the digital economy still has plenty of room for further growth despite the disruption caused by COVID-19. So on the topic of COVID-19, I think it is safe to say that the pandemic has caused a lot of stress on our lives, but at the same time, it has also revealed the importance of digital readiness. So during this period, companies that have performed well are generally those with an established online presence, while those that perform not too well typically do not. So a case in point is the retail industry, where we have witnessed several brick and mortar retailers such as JCPenney's file for bankruptcy. But at the same time, e-commerce firms such as the likes of Alibaba and Amazon have continued to report record profits over the same period. So COVID-19, we think that it has had a disproportionate impact on the various sectors of the global economy, with some more badly affected than others. But in the case of the digital economy, we think that COVID-19 is actually an unexpected catalyst, one that will produce a net positive impact in the long run. So we say so because we believe that after this, many companies will likely accelerate the adoption of digital technology, and that is not just to prepare for the next crisis, but also to remain competitive in a digitalized world. So as a matter of fact, we are already experiencing the positive impact of the pandemic on the digital economy, as the share price of OGIG, which is our recommended ETF for exposure to this sector, has actually more than doubled in 2020. So this is in stark contrast to the performance of broader equity markets such as the STI or even the S&P 500 index, which delivered gains of only 15% in 2020. So with that being said, investors who have held on to this ETF for the better part of 2020 would have likely made decent returns already and may want to consider taking some profits off the table. However, we caution against selling out completely. So the reason for this is when it comes to portfolio construction, asset allocation should always reflect economic reality. And the reality is that going forward, internet companies will make up a larger part of the global economy and the financial markets as well, as the world we live in becomes increasingly digitalized. So this is also the fundamental reason for why we have decided to include OGIG as a core component in our discretionary portfolios. So looking forward, even though valuations might seem a little stretched at this point in time, we note that the long-term outlook for the digital economy remains robust, as the industry is expected to deliver strong earnings growth, supported by megatrends such as rising internet adoption rates and the widespread digital disruption. So despite expanding at an exponential pace in the recent years, global internet usage remains far from saturated. So the number of internet users worldwide currently represents about 60% of the global population. That also means that there is still a large number of people who do not have access to the internet. So across the world, there are vast differences in the maturity and the extent of internet services available in each region. So developed regions such as North America and Europe, for example, are nearing saturation with penetration rates as high as 95%. The penetration rate in Asia, on the other hand, remains relatively low compared to developed markets. And this is despite the fact that Asian economies have a combined population of exceeding 4 billion people, accounting for more than half the global population. As internet penetration rates in Asia converges with developed markets, the digital economy is likely to see promising growth over the next few years, and with internet companies being the main beneficiaries. So besides the rising internet adoption rates, another mega trend that will contribute to the growth of the digital economy is the widespread digital disruption. So digital disruption is a transformation that is caused by emerging digital technologies and business models. And this in turn is caused by a structural shift in consumer habits, such as the shift from offline to online. So as more people begin to spend time online, digitalization has become a necessity for businesses that wish to remain competitive in this new global backdrop. To stay ahead of the competition, companies across all industries and sectors have been adopting digital solutions as an alternative source of revenue and as a way to improve efficiency. So e-commerce is a good example of this. So compared to the past, many brick and mortar stores today are turning towards e-commerce, which vastly broadens their reach. So in 2019, worldwide e-commerce sales hit a record high of $3.5 trillion US. So the majority of which came from China, which is currently the largest e-commerce market in the world. So over in China, players like Alibaba, Jingdong, and Pinduoduo control roughly 80% of the e-commerce market. So if you look over to the West, the US is actually the second largest e-commerce market. There, Amazon has a market share of roughly 50%. So the global e-commerce market is estimated to grow at a compound annual growth rate of about 16% over the next 3 years to reach a value of $6.5 trillion by 2023. So all in all, we think that as these megatrends begin to unfold, demand for digital products and services will continue to rise, and so will the earnings and share prices of these companies. So after all, earnings are the key driver of share prices in the long run. So investors who do not have exposure to the digital economy but are keen to invest at this point in time, you may want to consider using a regular savings plan. And the reason is because using a RSP will ensure that you buy more units when prices are low and less unit when prices are high, bringing your weighted average cost down. And in the future, when the opportunity presents itself, you can also always switch from an RSP to a lump sum investment then. So within the broader digital economy, one segment that we have our eye on is China. So China has come a long way since the 1980s, growing by leaps and bounds to become a global economic powerhouse. So today, it is the second largest economy in the world with an approximate share of 15% in global GDP. So part of the reason for China's rapid growth is its widespread use of technology. So for the majority of Chinese citizens, technology has now become an indispensable part of their lives, one that is hard to live without. So the importance of technology is also reflected in the financial markets as the tech companies make up some of the largest companies in China today. So compared to 10 years ago, if you can see from the chart, most of the largest companies actually come from the oil and gas as well as the financials industry. But despite the rapid growth of China's tech sector, we still think that China's tech sector is relatively young and there is still plenty of opportunities for tech companies to play a bigger role as the economy becomes increasingly modern. So similar to the rest of the world, a key factor that has contributed to the rapid growth of China's tech sector is the increasingly digitalized consumption habits of its people. So not only is consumption growing, consumption habits have also become increasingly digitalized where consumers are more willing to pay for the convenience of on-demand services such as food delivery, ride-hailing, to even more complicated things such as travel booking and online banking. These days, almost everything can be done online thanks to advancements in technology. And as consumption habits change, there are plenty of opportunities within China's tech sector. So earlier, I mentioned that China is actually home to the largest e-commerce market in the world. And this is because e-commerce is becoming the new model of retail in China, with the percentage of retail sales conducted online increasing steadily over the past few years. And as of 2019, roughly 20% of the total retail purchases in China is done online. And that number is actually expected to increase over the next few years as the country becomes increasingly digitalized. So besides the greater use of technology, there are a couple of reasons why the online consumer market in China is booming. So first of all, with greater economic progress, wages are rising, and the Chinese population is getting wealthier than ever. And when I say that, I don't just mean for the people who live in the cities, but also for the people who live in the rural regions as well. So disposable income for both groups are at an all-time high, which leaves people with more money to spend. Second, China has a huge number of internet users. So even though its internet penetration rate of 61% pales in comparison to developed markets, China already has 850 million internet users. And that number is actually greater than the total population of every other country in the world, with the exception of India. And with penetration rates on an uptrend, internet companies will stand to benefit as online consumption rise. So here's a graphic for you to visualize just how large China's internet space is. So as you can see from the various segments, even though China has a lower penetration rate, the number of internet users still far outweighs the US. And the only segment where China has a higher penetration rate than the US is actually in mobile payments. And this is because China essentially skipped the entire credit card era, moving straight from cash to mobile payments. So these days, mobile payments, they are a widely accepted mode of payment for most merchants, from restaurants to even street hawkers. So if you're planning a trip to China when travel resumes, make sure that you familiarize yourself with how these apps work before you go. So earlier, I mentioned that the number of internet users in China will rise over the coming years. And these are expected to come from two distinct sources, which are your millennials and the rural population. So let's talk about millennials first. So for Chinese millennials, it is estimated that there are roughly 350 million of them. And millennials, many of them, they are brought up in an era where they are constantly exposed to technology and have grown to become avid internet users. So in fact, millennials actually contributed to 2/3 of the total online consumption growth last year. And with their higher spending power and greater propensity to spend, millennials are progressively becoming China's biggest source of online consumers. Next, China's rural population of 560 million people is another huge untapped market for internet companies. So penetration rates of only 40% in the rural regions still remains well below urban regions' penetration rate of roughly 60 to 70%. However, this is quickly changing as the government has been pushing big telco players to speed up the construction of internet infrastructure so that the rural population does not get left behind. So the rising number of internet users from the rural regions will present Chinese tech companies with new growth opportunities. And in fact, many internet companies like Meituan, for example, have reported that growth in the recent years is largely driven by the rural regions. So all in all, we think that China's technology sector is still in a nascent stage and it still has plenty of opportunities for investors as the country becomes increasingly modern. So now that you have a better understanding of China's tech sector, let me introduce to you our recommended ETF, which is the iShares Hang Seng Tech ETF. So this is a new ETF which was only listed on the Hong Kong Exchange back in September last year. And the objective of this ETF is to track the performance of the 30 largest technology companies listed on the Hong Kong Exchange that have high exposure to tech themes such as the internet, cloud computing, and e-commerce. And to be included in this index, companies must fulfill certain requirements such as having minimum turnover, revenue growth, as well as R&D expense. However, do note that for this ETF, unlike OGIG, this ETF does not purely invest in internet companies as it also contains a number of hardware companies such as Sunny Optical and SMIC. So other notable holdings for this ETF would include many of the Chinese internet giants like your Meituan, Alibaba, and Tencent. So besides the exposure that it gives, another reason why we have chosen this ETF is because it ranks well compared to its peers based on our own in-house ETF selection methodology, where we analyze a variety of factors such as your expense ratio, tracking difference, and liquidity. And we like this ETF because it has one of the lowest expense ratios among its peers, making it the perfect instrument for cost-conscious investors. And as we already know, high expense ratios, they are not very desirable because if they are compounded over a few years, they can be a significant drag on returns, which is why we tend to favor ETFs with lower expense ratios. So overall, we think that this ETF is actually one of the best in the market for investors who are seeking exposure to China's rapidly growing tech sector. So in conclusion, given the structural megatrends behind the digital economy, we believe that internet companies will be able to deliver superior earnings growth over the next few years, which is a key ingredient that will drive share prices higher. And investors who are seeking exposure to the global digital economy may want to consider the iShares Global Internet Giants ETF. Alternatively, those with preference for China can consider the iShares Hang Seng Tech ETF. So with that, I've reached the end of my presentation today. I hope that through this session, you have been able to gain a better understanding of the digital economy, its prospects, and most importantly, why we are so positive on this sector. Once again, my name is Terchin. Thank you all for being here today, and I wish you all the best in your investing journey.
Thank you, Terchin. Coming up next, we have a special message from Catherine Wood, Chief Investment Officer and CEO at ARK Investment Management. Also speaking will be Mr. Darius Fu, Head of Intermediary Business Development at Nikko Asset Management. He's currently managing a team that oversees several key relationships in the Asian region, providing them with product solutions, training, sales, and marketing support. His topic today is Disruptive Innovation. Why now? Darius, please.
Right, a very good afternoon to everyone. Thank you once again. And I understand that I'm pretty much the last solo presenter before we end the day with another Q&A session. And I think Terjun has done a very wonderful job framing up what the internet, what this entire e-commerce scenario is. And yet we dwell to yet kind of like a sub-sleeve of what is called disruptive innovation. So I'm going to take us through in the next 20 minutes what disruptive innovation is all about, why we should be investing in this during this period of time. So before I get started into the content proper, I'd just like to introduce the people behind the fund and behind the strategy, and that is obviously us at Nikko Asset Management. If you're not aware of who we are one of the largest asset management companies from Japan, and you can see on this slide, our AUM is about $249.4 billion. So it's to say that we are quite a reputable and obviously sizable fund house. Now, the other more important aspect as you look on those numbers is that we manage a multitude of different asset classes. So we're not just packed into an Asian specialist or a global specialist, but we really have investment people who can do a multitude of asset classes and churn out good products for everyone. And I'm sure in the midst of all of you, there are investors who have bought into our unit trust products as well as our ETFs before. Now, very importantly, who are the people that we partner to bring this product to you? And that is really the team from the ARK Invest company. So the ARK Invest team was founded in 2014 by Catherine Woods. And I know that many of you here today, especially in my industry, there are a lot of friends who have been messaging me and say, hey, wow, you guys got Catherine to be able to come and present. So I want to just manage expectations off the fly and says she's not here physically with us in the studio, but she has recorded a message specially for this particular purpose, in which we will share it somewhere down the line in my presentation. So stay tuned for that. But really, if you know Catherine and her team, then they basically need no introduction. They are the experts in terms of looking and understanding the technologies that is being created and worked upon today as we speak about disruptive innovation. Now, I understand that, during this period, there are two key groups of investors that are watching today. The first group who are very aware of disruptive innovation, and the second group who could be a little bit newer to this. So to the first group who are aware of disruptive innovation, who have perhaps even supported us through 2018 to 2019 in the fund and all the way to 2020, we want to say a very big thank you. But do bear with me as I explain a little bit to those who might be new to the strategy about what disruptive innovation really is about. So just to lead us through, why this product or why this strategy will fit into your portfolios. The first thing to understand, obviously, is that as we emerge from a world devastated by so many other things of the past, we essentially feel that you need to innovate in order to grow. Now, if companies don't innovate, if companies don't learn, to make better use of technology, then what happens is they will be stagnant and they will fall behind. So obviously, when I say innovation is key to growth, this makes sense for every single company out there. Now, no fund manager will stand down here and says, rest on your laurels, don't do anything, because that is only applicable if you invest in a perhaps, distressed asset kind of a fund. But everyone understands innovation is key. But how do we then define what truly innovation is with respect to this strategy? So I want to just paint a little bit of history for you first and foremost. Now, while technology is something that has been ongoing for many, many years, I want to draw your attention to the last 200 years of history, as you can see from the charts. And in the last 200 years, I need to take you back almost, to the time of the steam engine. Right? During that period, the steam engine was perhaps one of the most noticeable, innovation platforms of that period. And what that does is that gave rise to this thing called, railway trains. And because of the railway trains, you then, have the next innovation, which is called the combustion engine, which then gives rise to the cars, so on and so forth, that we know today. But in this chart, what is most important that I like to draw your attention to is the fact that when you look at the last 200 years, there has never been a time where there has been more than 3 innovation platforms converging at the same time. And that will be when you see electricity, automobiles, and even telephones, for example. it is only during the last 20 years you start to see the computers, the internet, and the rest of the things starting to stack up, that you see a huge convergence of technological platforms taking place at one point in time. So if you are asking that question, why invest in technology today? The reality is this: it is not because in the past it was not viable, but it's really because today is when you see that many technological platforms. The opportunities today were not available 3 years ago, 5 years ago, so to speak. So with that in mind, I'd like to just draw on two more very important terms to understand our strategy before I shed a little bit more light on what goes on in terms of performance and what goes on in terms of the portfolio. And the first thing that I need us to understand is this word called disruptive. Now, when I say something is disruptive, ladies and gentlemen, in the Singaporean context of things, I know most of us are thinking of our past examples of Grab, of Uber perhaps, right? When they came into the marketplace and they disrupted this huge giant called ComfortDelGro. But make no mistake, as I am about to showcase to you, when we use the term disruptive, it is not about companies who just come in very quickly to capture market share. When we talk about disruptive, one thing needs to take place. And if you're looking at this slide right now, I'd like to draw your attention to the extreme left-hand side. And you will see the title called Cost Curve Decline. So for any technology to truly become disruptive, the first thing that needs to happen is the usage of that particular tech needs to come down in the sense of the cost. So across these three slides, what I'm going to be elaborating on is electricity. So when electricity was first founded, electricity was very expensive to generate. And as you can see, that's why the cost curve went up. But then it came upon a time where people realized, hey, I can burn coal, I can burn natural gas, I can use hydro dams, so on and so forth. Then the cost of producing electricity suddenly fell dramatically. And when the cost of electricity fell dramatically, that's when it truly becomes disruptive, because different other industries start to use electricity, which is what we call in the center chart the cross-sector ramifications. So you start to see the automobile industry using electricity, right? The other manufacturing, F&B, so on and so forth. But more importantly, with technology, it doesn't stand still. So sometime about 40, 50 years ago, then came the invention that we know today, known as the battery. People were not only able to produce electricity, pass it through cables and wires, but they were able to store it into little, things called batteries. And from there, companies also innovated. They changed the raw material of batteries to become rechargeable batteries. And even in today's context, there's even more R&D that's going into it, such that you have rechargeable batteries, lithium-ion batteries that can power everything from an e-scooter all the way to an electric vehicle. So that's very important that I want to put in your mindsets first and foremost. When we say disruptive, it is not just a company that comes in, take huge market share, because somebody else is going to be able to come in, do the same thing that you're doing at a fraction of the cost, and then in a way you lose the market share. But that is not what we term in this particular strategy as disruptive. So I hope that gives you a good idea of what we mean by disruptive, which leads me to the second term that I really want to define, what is called an innovation platform. Now, a lot of times people will be talking about innovation from the perspective that, oh, this company is coming out with a new product, so on and so forth. But to us, an innovation platform is on the right-hand side, you can see things like artificial intelligence, energy storage, robotics, DNA sequencing, blockchain technology. These are technologies today that don't just work for their own particular field. Now, when I come to this slide, two things typically happen. In my other presentations, I will get clients who ask me, hey, Darius, how about solar? Isn't solar an innovation? How about quantum computing? How about virtual reality? Now, all these things are really innovative at the same time. But remember my first definition, which is disruptive. If virtual reality is so cheap today, ladies and gentlemen, I won't be presenting across to you via a video screen. Today, I will be a holographic image standing in your living room having this conversation with you. But the fact is, while those technologies are innovative, they are by no means cheap, hence not disruptive. In this point of time in history, these 5 things are what we consider disruptive because their cost has come down tremendously. Now, that's to say, with a strategy like ours, in time to come, when cost comes down for solar, when cost comes down for things like, virtual reality, we will be able to add them into the portfolio for you. But that being said, you're not buying into 5 specific sectors because there are a lot of companies that use these different, technological platforms and produce their goods and services. So famously, a Tesla, for example, will be someone that we will consider a play on energy, a play on artificial intelligence, and a play on robotics. And that's why you see on the left-hand side of this chart, these 13 to 14 other subsectors starting from things like adaptive robotics, 3D printing. They are interplays that are derived because of the 5 innovation platforms. So ladies and gentlemen, I know and I promised you that Catherine is going to come on at this point in time. Some of you who have been invested in the fund already, I'm very sure the fund has done well for you and you want to know what's up next. So I'm going to pause here for a moment before I come back to round off and hand this time now to Catherine, who's on video. It's a recorded video while she shares to you what has taken place in 2020 and what she expects to come.
Greetings. My name is Kathy Wood. I am CEO and CIO of ARK Invest. We have been saying for a very long time that 5 innovation platforms that involve 14 technologies are ready for prime time. The coronavirus crisis has turbocharged all of them. They are in prime time. That is why they're taking off at a much faster rate than even we expected. And we've been trying to communicate the opportunity, and many people have received that well, which is great. But then as we're talking to investors, we have been a bit frustrated that we haven't been able to communicate to those who really feel like the broad-based benchmarks are where they are the safest place for them to gain exposure to the stock market broadly. And so we put out, in order to illustrate that that is not true, that the broad-based benchmarks are not a good place these days because of all of this innovation, we put out a report called Bad Ideas. It's on our site. And we talked about all of the fixed assets that are effectively becoming stranded assets, whether we're talking retail or banking or energy or anything auto related, even auto insurance. We think that a lot of sectors are in harm's way, and those sectors make up more than a third of the S&P 500. Which is the benchmark that many people use as their gauge. So 35% is a big risk and will lead to, we believe, subpar returns. So I'd ask any of you who are wondering about the fixed assets that are going to be stranded and why they're going to be stranded and why book values are going to be written down. Exxon last Friday wrote down, I think it was somewhere between 20 and $30 billion, which is about, just for perspective, about 20% of its equity market cap, which is crazy. But it's true. And that's because innovation is just blasting through the traditional world order. Now, more on innovation during this post-COVID crisis environment. Some interesting convergences are taking place. We know we've gone remote to work. We know we're enjoying digital entertainment. We know we are going to the doctors through virtual visits. But something else is happening. There's a convergence among all of these digital services. We're seeing a convergence between entertainment and gaming. So social gaming, streaming gaming. We're seeing social commerce, so combination of online retail and a social experience like group buying or influencers helping us figure out what to buy and why. And social media is developing new dimensions with virtual reality and augmented reality. So we believe that we are moving into a digital third place, the metaverse. So there's always a question of valuation when we're talking about innovation. And it is true, the PE ratios of innovative companies are very high today, but there's an important reason why. Many of them are investing aggressively now because these exponential growth opportunities are in very early days, and many of them are winner take most. In other words, the companies with the highest quality data and the most data and the best artificial intelligence expertise are going to run away with some of these markets, be the dominant players. Now, many people compare today to the tech and telecom bubble. It couldn't be more different. In the tech and telecom bubble, the seeds for all of the innovation taking place now were planted. But they were planted and they were going to take 15 to 20 years to gestate. So here we are 15 to 20 years later, and these technologies are ready for prime time. So we are not going to have to value stocks using number of potential eyeballs, which is what investors did and speculators did in the tech and telecom bubble. Today, we are looking 5 years out and we're saying, where is this exponential growth going to take this network, this platform, this technology? And if the growth is exponential, we are willing to pay a lot today for companies to sacrifice short-term profits in order to capitalize on some of the biggest investment opportunities of our lifetimes. So we at ARK and at Nikko Asset Management, our partner, we are ready and waiting to help you stay on the right side of innovation, the right side of change, and to a very exciting new world order. Thank you very much.
All right, welcome back. I hope that with the sharing that you have heard from Catherine, that gives those existing investors some kind of comfort, some kind of color in terms of what she has been doing with the portfolio in 2020 and with regards to how she's positioning it for 2021 as well. Right, so just coming up to the last 6 minutes of my presentation, I want to do a couple of things. So in adding this fund into your current model portfolio or your existing range of products, what is it really that Nikko AM is hoping to do for you as an investor? We hope to do 3 things. And the first thing is this: we hope to be a genuine source of growth. And in a short while, while you heard Catherine talking about how well, certain companies or sectors have been for us, you're going to see our fund performance. And I hope that you will see that this is really something that you can add in for a good, alpha kicker within your portfolio itself. You're going to see the second thing, which is true portfolio diversifications. Many times I hear investors, when they hear about the fund name, Disruptive Innovation Fund, and they go like, oh, I know, you're going to ask me to buy Apple, Amazon, Google, so on and so forth. And I'm going to surprise you by showing you in a short while, the portfolio actually doesn't have all these big tech kind of names. So we've achieved the performance that we've gotten, really on the back of a well-diversified portfolio. And I have to say, hand to heart, many of the names when I first joined Nikko Asset Management, I didn't even know of them. I had to go and do some research before I understood what these companies were doing within the portfolio. And last but not least, obviously, if you're adding something like that into your existing fixed income mix, or if you're already a multi-asset investor, or even if you are a global equity investor, by putting this together and getting the actual portfolio diversification that you need, you're going to get a much better risk-reward kind of a profile. So let me go into the meat of what I'm talking about. As you can see on this slide, we've done exceptionally well from a performance basis. On the last 3 months, we've done 18% on the USD share class and 16% on the Sing Dollar share class. And on a one-year basis, you see that we have managed to perform a whopping 117% on the USD share class and 112% on the Singapore dollar share class. Ladies and gentlemen, that's not a rounding error, that's not a decimal point mistake, that's literally $10,000. If you put it in the fund, it is now $20,000 and more. And in fact, we're so thankful to FSM1 especially, because over this entire 2020, our fund has constantly been up there in terms of one of the best performing funds in the universe. But that is all fine and dandy, and compliance is going to compel me to say that past performance is not indicative of future performance. So how then, most of you will be typing furiously right now, if the fund has done 100%, how is it going to do for 2021? Which leads me to the next slide to showcase to you what is actually in the fund that will help you to get better returns. Now, if you had heard Catherine just now as well, and in the future, while she's conducting her more recent interviews as well as commentaries, she's going to tell you that this 100% in 2020 was an exceptional one-off. All right? It is unlikely that we're going to repeat 100% in 2021. But that being said, how are we giving you, the growth that you need? Well, I'm going to come to that as I round off this slide, but what am I trying to showcase to you here? So firstly, if you look at the left-hand side of the charts, right, on the left-hand side, you will see the top 10 holdings. And on the top 10 holdings, as promised, there is no Alibaba, there is no Apple, there is no Google. We're achieving it off the backs of very, very unique companies. And as you would have heard earlier on, COVID-19 has done exceptionally well for us, really because a lot of companies have expanded their use of technology and have gone on to do, capture market share and do really, really well. So one good example that I want to point out to you, for example, is Teladoc at number 6. Teladoc is an online pharmaceutical company. In the US, when you see a doctor, he gives you a prescription. You go to the pharmacy, you buy medicine from there, and then you go home. Now, in the past, in the US, before COVID-19, online purchases of medicine was only about 10% user rate. Because of COVID-19, because of the pandemic, closures, etc., that user rate has gone up to 40%. And now, with this 40% of people who have bought, medicine online, get it shipped door to door without the need to even get out of their house, it is arguable that they will continue to use this methodology. And as you heard from Terjun earlier on, this is not just a US phenomenon, it's a global phenomenon where people's changing consumption habits will benefit, these tech companies over a period of time. So I hope that, just by looking at the top 10 holdings, you get that comfort that we're truly asking you to buy into companies and names that you are not existingly owning in a multitude of other products. Now, on the other spectrum, on the right-hand side, you will see as well that while the name is Disruptive Innovation, it will surprise many people that our largest holding is actually not tech. At this point in time, the most innovative sector is actually healthcare. Now, of course, that's followed very closely with tech because we've got e-commerce, online storage, etc., right? And all these are weighing very heavily. But the benefit of this product as well is this. The day will come where finance could be the next most innovative, sectors, or consumer discretionaries. And what this means is that we have the ability to switch. Now, if you are invested in certain funds that are only limited to one kind of technology or one kind of exposure, they have no bandwidth to switch around when the opportunities come about. This fund is going to be evergreen. When the next opportunity comes about, you will see us start to buy into it in a very big way. Last but not least, as you are studying and learning more about our funds, we are not, really focused on things like healthcare as a tag and all that. The center portion, which is what we talk about most often in our commentaries, things like cloud computing. And that's really because our analysts are all grouped into the specific technologies that they are researching and or have studied along the way. So we're not getting a bunch of analysts who are in their 40s, in their 50s with 20 years of experience. Our team of analysts under Catherine literally have an average age of about 32 to 33 years old. And many of them, they have actually worked in all these pharma companies or in all these tech companies before they join us on board as fund managers. So the key difference is they really, really know the technology very well. So ladies and gentlemen, I'm sure that while I am opening a whole can of worms and there's going to be a multitude of questions that's coming in, I want to just round off this slide by giving you one last assurance. Catherine has always been asked also, what is the prospect given that you have done 100%, that your fund is going to continue to do well in the next 1 year? And the reality is this, while we're looking for growth, she always summarized to say that we're looking for growth by finding companies that can double their share price in the next 3 to 5 years. So realistically speaking, we're asking for all these companies not to do 100% or 700%, but we're asking them to return 15% year on year. And after 3 to 5 years, they would have achieved that doubling effect. So I hope this also gives you that comfort that if you're looking at the Disruptive Innovation Fund for 2021, the realistic expectation is for us to do about 10 to 15% returns for you, and you can speak to the guys at FSM1 for more advice in terms of how that fits into your overall portfolio allocation. So in closing, I just want to end off with this last few words. Some of us, we look at 2021 as a year of uncertainty. We don't know what's to hold, right? Looks empty. But I hope that after this sharing, you guys will have some ideas that you feel are worthwhile to explore and add into your portfolio. Now, sometimes when we're looking at stocks and shares and you do it once and you think to yourself, that's just coincidence. Can't be. I just, if I am permitted to use a Singapore slang, heng only, buy the right thing. But you know what? I'm very sure that as you do a little bit more homework, as you attend the next few days together with SSM1, you are able to find out that there are more opportunities that you can encounter. And last but not least, first time lucky, second time a coincidence. I hope that once you've started this journey, not just with ourselves, Nikko Asset Management, but with our partners, FSM1, you realize this is something that becomes repeatable time and time again. I hope you're giving me a round of applause over there at your homes. I thank you very much, ladies and gentlemen. And with that, I would like to hand the time back to the MC Geraldine. Thank you.
Thank you, Darius and Catherine. To find out more about the Nikko AM ARC Disruptive Innovation Fund, click on the Partners tab on your event live page and head over to Nikko AM, where more information on the fund can be found. We'll now take a 5-minute short break as we head over to our speakers at the Q&A panel, where Will from iFast Hong Kong, Tan De Jun, and Ong Ziyang will be on hand to take your questions. Moderating the session will be Ferlin Tan, who is an equity analyst at iFast Singapore. If you have any questions regarding the presentations today, you can ask them in the Q&A section by clicking on the Ask Question button. We'll have our speakers to answer your questions later on today. In addition to discussing your questions submitted through the Q&A function, they will also be discussing the recent political tensions between Chinese tech and global tech. We'll see you in a few minutes. Welcome back, everyone. Joining us here on the panel to take your questions will be Will Sham from iFast Hong Kong, Tan De Jun from iFast Singapore, Ong Zi Yang from iFast Singapore, and moderating this session is Ferlin Tan, who is an equity analyst at iFast Singapore.
All right. Thank you, Geraldine. Welcome back to the final session of today. So in the next 15 to 30 minutes, we'll be taking in some questions regarding the topic on global versus China tech. So I see there are already a few questions that have started rolling in. So perhaps maybe we can kickstart this session with a more general question. So gentlemen, the first question is within tech, the technology space, are there any specific themes that we should be watching out for in 2021?
Maybe perhaps I'll start. So I think within the technology space, one subsector that I'm quite optimistic on is actually the semiconductor industry. So the reason for this is because semiconductors, they are the bedrock of all technology, and they can be found in almost every electronic device, from your smartphones, your PCs, and even your coffee machine. And because of that, if we believe that the world will become increasingly tech-driven, then semiconductor companies, they will have a much bigger role to play in the growth of the tech industry. Yeah.
Sorry, so maybe to add on a little bit more, another subsector that I quite interested about for technology would be the e-commerce as well as the fintech sector. I think I think the trend of us moving our purchases online has been well underway before COVID. But what COVID did change is structurally the paradigm shift is now sort of permanent. I think before this COVID situation, majority of there will be some people who are still a bit skeptical about purchasing for not just your items online, your apparel online, but also food and services online. But because of the social distancing and all the measures, lockdown measures, it actually made people. A lot of people who are naysayers probably took their first try. And then maybe, I think for a lot of businesses, a lot of, especially the internet players, one of the biggest thing would be trying to get new users to onboard new users. But because of this unique situation, a lot of retailers, a lot of consumers actually probably get exposure to it and then become very comfortable with it. So moving forward, we think that it actually accelerated the trend. And because of that, e-commerce players like your Alibaba, your JD on your China side will continue to thrive. And if you see over the last couple of years, in fact, I think the Double 11 event that ended not long ago hit a record high, even though each year it has been breaking record. And on the US front, I think people who are very familiar with Amazon continues to purchase even more from Amazon. And that is a trend that is well underway. And alongside such e-commerce player, I think because when you want to purchase for items online, you need online payment modes. And that means that companies who cater to this, say your PayPal, a lot of your fintech players, are going to benefit because of that new shift, that structural shift towards purchasing things online. So there's a specific sector that not just benefit on because of the current situation, but on a longer trend, circular-wise, they are going to benefit as well.
Yeah, so my take would be, I also actually quite like the semiconductor as well as the e-commerce. But another area I would more prefer is the CTV advertising, the connected TV advertising, which will be the biggest business. Because every year the advertising expenditure around the world, across the world actually, amounts to 160 billion US dollars, while the CTV and also the streaming TV already shares 20 to 30% of the total number of audience in US. Really depends on which data you are looking at or the source you are looking at, but roughly around 20% to 30%. But and also they are expected to expand to around 50% thanks to the pandemic, which make a structural shift. And also they are already fast-growing pace over the past few years. So they are expected to expand to around 50% of the market share. But the revenue share only worth around 10% of the total market. So the CTV advertising leaders will definitely benefit from the larger pie. Another area within the semiconductor would be the 5G chip maker. Actually, over the past 3 to 5 years, I think most of the 5G infrastructure have been done. And in this area, it is the competition mainly between Huawei, Nokia, and Ericsson. But after the 5G infrastructure, in the next couple of years, it will be the 5G application investment cost. All kinds of electronics and digital device and handsets will be capable to connect with the 5G network. So the so-called 5G MIFI hotspot service provider and also the radio frequency front-end chip in industry will gradually improve its strategic position due to the more products being widely used in the so-called mobile smart terminals.
All right. Thank you, Will, and everyone else. So now speaking of tech, we know that in 2020, tech was probably one of the main key drivers that helped to propel the equity market. And no doubt that tech stock had a great run up over the past few quarters. So, and I saw that in the Q&A session, there are a lot of questions on US tech and their valuations. So there are a few questions that ask that with US tech stocks they have been so expensive for a few months. So one question is, why are they still going up? So Ziyang, do you have an answer for that?
Okay, maybe I'll start first. I think there is a few factors why the US tech has done so well. I mean, they're expensive, but probably rightfully so. I think one of the first key reasons, as a majority of you guys probably would know, is that they are sort of the winners for the COVID situation. Although overall, the COVID caused us a lot of caused a lot of disruption within the economy, and wasn't very convenient to us. So all of us were staying home, and then we are actually spending more time online through the internet, through purchasing online stuff online, playing games online, watching more Netflix, and listening to probably your Spotify online because of the unique COVID situation. So while the rest of the world, for a lot of different sectors, especially the airlines and the more traditional brick and mortar retail are contracting this year, the earnings for these tech players actually rose up quite a bit because of this. I think that's one of the key reasons. So they're sort of the winners for 2020. So if you look back, 2020 was a bad year for majority of them, but for your giant tech internet giants, it's actually a very good year for them. So the second reason is because I think it's the whole stocks ecosystem as a whole, the stock universe, is that they benefit from, because of the low interest rate environment, the stock is actually very favorable for stocks. And that's also the reason why you see not just the US stocks, but actually stocks all around the world actually perform quite well, even though we are seeing a global recession all around the world. And because of this, and I think because of the COVID situation, although there is vaccine hopes, and I think the vaccines are starting to implement across and roll out across the world, growth is still, the total global growth and growth is recovering. But overall, I think the growth expectation is still quite not as high. It's still quite low. And in this low growth environment, people tend to flock towards high growth companies and sectors, which is where the US tech players are situated at. So yeah, they are actually These three are the three key reasons why the US technology stocks have done so well. I think they have close to doubled in 2020, and that's also the reason why we think that moving forward, there's actually still a runway for them.
Right, now you mentioned that we have the US tech, the tech sector in general still have some decent upside potential. So another common question we have is that given how that prices are deemed to be high and to some might be overvalued, so one question is how can retail investors gain exposure to this sector? Perhaps Tachin?
Yeah, sure. So I think just to add on to Ziyang's point also, the reason why I think prices are still continuously going up is because markets are forward-looking, and so investors should also be forward-looking. So based on current valuations, the valuations of many tech companies, they might seem high, but if you look forward 2, 3, or even 5 years, valuations will seem a lot more reasonable then. So I think that is one of the reasons why people are willing to pay higher prices for tech companies. So in an environment where share prices are rising, how should you invest in technology stocks? So I think one of the ways you can do so is perhaps you can use a regular savings plan for the time being. So that means you buy less units when prices are high and more units when prices are low, which will bring your weighted average cost down. And in the future, should any opportunities arise from negative sentiment or whatever, and prices do come down, then you can consider switching to a lump sum investment.
All right, thank you, Tachin. So now another very general question that we have over here is none other than the tension between US and China. So we know that recently US has been looking to ban Chinese companies due to the tension between them. So one of the common questions here would be about the delisting of Chinese companies. So anyone from the panel, can you try to explain how would the delisting of China equity in the US to affect the stock markets? And also given the tension, is it still okay to buy these Chinese companies that are listed on the US exchanges? Anyone want to take up first?
Okay, maybe I'll yeah, okay, Will, yeah.
Yeah, perhaps Will, you go first?
Okay, so actually I don't think the US government will ban all the Chinese firms to be listed in US because it will be seen as a very unfriendly move, not only just to China, but also as an open market, which is crucial to be a successful financial market. So I think some sensitive sectors like the telecommunications and also companies with the military cooperation, of course, with higher risks. But most of the ADRs are those softwares, applications, e-commerce, and more rely on the domestic consumption-related themes. And there's nothing to do with the suspicious activities, I would say. So yes, whenever there are some news or rumors that U.S. government will make financial sanctions, the U.S. ADR's share price will become more volatile. But on the fundamental side, I can say that it has almost zero impact to many of these ADRs. So imagine that since 2018, when the U.S. started trade war with China, if we look back at the share price of Tencent or Alibaba, if we can go back to 2018, will you or we buy the shares when they were down because of the conflicts? For sure, we will. But so I think don't be too panic or overreact to this news.
And kind of to add on to what what Will has suggested is that a lot of these China equities, especially your China giants like your Alibaba, your Tencent, your JD.com, they are very strong companies, and they actually depend largely on revenue driven within the domestic China market. And if we expect China to continue growing, especially this year, where they are actually starting the year with firmer foot, and its citizens get more to get wealthier and to spend more online, these businesses will continue to drive larger earnings growth and profit. So delisting of these China companies from the US market is actually quite a myopic stance, and also the reason why we think that even if they threaten it, it will be a very difficult process for them to remove it, because if they do that, there is actually an alternative for you to gain access. I mean, investors will still want to get exposure to these China companies, and they will just go to another exchange, which is the Hong Kong exchange. And because of that, NYSE, your US exchange, will lose such a huge pie of the profit that you can actually get it through a trading volume of your China equities. So it will be, yes, maybe on the security end, it will be a win for, say, your US government, your political reasons. But overall, I think it's actually quite a myopic thing. And I think if you take everything into, especially if you take earnings into I think the exchange will think twice before they actually try to delist the China companies, so such big companies.
I understand. Yeah, I think it sounds like the delisting will be like a lose-lose situation for everyone. So speaking of this tension between China and US, I think one of the biggest action that US has taken would be to ban the semiconductor companies, or like ban the sale of semiconductor to like Chinese companies. So one of the most voted question of the day is actually, can China be self-sufficient in the production of chips and semiconductors? So perhaps, Will, do you mind taking that question?
Yeah, so actually based on the Make in China 2025 project issued by the Chinese State Council in back to May 2015, there are two main directions. The first one is by 2020, 40% of the core basis components and also the key basis materials will be independently guaranteed. The guaranteed actually means they will be produced by local market, by China their own. And the second direction is by 2025, 70% of the core basis components and key basis materials will be guaranteed independently. So among this, they also propose that China chips self-sufficiency rate will continue to increase, but there's no concrete ratio to be thrown out. But I think a little bit hard to do it all by your own, because if you look at the semiconductor, it's just way too broad. I mean, actually each country has their own specialty. Like in foundry-based, Taiwan TSMC, Korean Samsung are the only firms which can produce below 10 nanometers. I mean, for mass production. And then for IC architecture, UK's ARM, and also US Intel dominance in this area. And then for sampling, assembling, packaging, and also testing, Taiwan's ASE group is the leader in this space. But imagine that to make a chip, TSMC actually need a EUV machine from Netherlands, ASML, and also relevant equipment from US Applied Materials, while Taiwan's ASE group do packaging and also the packing and also testing. They need machines from US KLAC or the Lam Research. So you know that no one can actually do it all by their own or by themselves. Before Intel was a IDM, the integrated device manufacturers, that they want to do the entire flow by themselves, but then doesn't really efficient and competitive enough in each of the supply chain or the flow of the semiconductor, because to do everything by yourself, which means that you are losing your focus and advantage, because the resources are diversified to different parts, so that you are not able to compete with the firms which put all the resources to do the best and specialize on one part. Even for ASML, for example, to produce a EUV machine, it also doesn't only rely on Netherlands or SAI or ASML technology itself, also comprised of other countries' technology like Germany, SAI, US Simers, etc. So many people still focus on whether China will have its own TSMC and can produce their own EUV machine. Of course, they want to achieve that, but I think if If they can do that, it would be a great achievement. But even without doing so, it doesn't mean it's failure, because the threshold or the benchmark is just way too high. It really takes time to achieve. Another direction is to gain share in the whole semiconductor supply chain, like the etching machine for 5 nanometer chips of China, AMEC, has already passed the validation by TSMC, and also Shenyang King Semi, which produced the coating equipment, has already successfully entered into the supply chain of the TSMC. So going forward, I believe that many of these Chinese semiconductor players will try to enter into the supply chain of the whole flow rather than do it all every single space.
Okay, maybe just to add on another point, which is China is the largest electronics manufacturing hub in the world, but it is estimated to produce only roughly 25 to 30% of all the semiconductors that it requires. So given that their livelihood is so much dependent on semiconductors and how semiconductors are important to the global technology sector, I don't think that with the US putting increasing pressure on China, China would just give up. It's no secret now that China's semiconductor manufacturing technology is nowhere near its Western peers or even Taiwan. But I think that because of this and because of how important semiconductors are to every country, China will actually double down on its efforts to grow its domestic semiconductor industry, and in the future, it will eventually catch up to the technology of their Western peers. Yep.
Right. Okay, thank you. Speaking of Taiwan, just so you mentioned something, there's this question that asks about any prospect in the Taiwan tech sector in 2021. I would assume like one of the biggest player in Taiwan technology sector would be TSMC. So perhaps Jin, do you mind sharing your view on TSMC?
Okay, so right now TSMC is the most advanced foundry in the world, and it has contracts from many US companies, many Chinese companies. So I think TSMC, given its unique position as a pure play foundry, it has actually did quite well over this period, as it is one of the only advanced foundries that are able to produce like 7 and 5 nanometer chips. So I think going forward into the future, TSMC, if it is able to keep up its R&D, it is able to keep up its technological expertise, it will still be a very important player in the semiconductor industry. So no doubt that other foundries from South Korea and from China will try to catch up. But if TSMC continues to invest in their R&D and extend their technological lead, then I think they should be in quite a good position over the next few years.
And to add on a bit on, I think Taiwan is sort of quite a powerhouse in terms of semiconductor as well as electronic component in the whole entire globe. I think Will just now also mentioned that when it comes to semiconductor, it comes to computer or electronic components, it's more of like a global supply chain. A lot of countries, a lot of economy depends on each other across the whole entire industry value chain. So because of that, because of the increased demand for electronic products, especially because more businesses are moving into a work from home kind of scheme, and likely to stay so for this entire year. Classrooms education is also going into partially between to take on a more like e-learning style kind of thing, and this also fuel demand for your laptops, your smartphones, as well as the 5G cycle. So Taiwan is a very important player within this industry supply chain. So as a result, because of that increased demand, we expect that Taiwan will continue to export even more electronic products ahead. And with the economy being being very tight together with these electronic exports, we think that the whole entire economy will do pretty well this year as well. So I think last year, if you look at Taiwan equities as a whole, it's one of the top performing market, and we would like to think that 2021 would be the same story for them as well.
Okay, thank you, Ziyang. Thank you, Jin. Now moving on, maybe let's go into some more specific type of questions. So the current top voted question would be on a Chinese company. So the question is, what is the future of Alibaba? So can anyone try to take this question?
Okay, maybe I'll start. So I think Alibaba has been in the news lately for the wrong reasons. I think it has entered the crosshairs of the Chinese government and on increasing regulations on both Ant Financial as well as its e-commerce business. However, I don't think that increased regulation is necessarily a bad thing, given that these companies, they are the national champions of China. So if China wants to be globally competitive, they have to rely on their technology companies. Yep. So I think that increased regulation, it is mainly to protect consumers as well as the financial health of the country, but not to strangle the growth of Alibaba as a whole. Yeah. Maybe the other guys can chime in also.
Yeah, maybe I'll add on a bit more before. I think Will will probably have some comments on this as well. For Alibaba, I think it's a whole entire ecosystem. It's a global internet giant, so not just its e-commerce. Of course, the e-commerce right now is bread and butter, but it's not just the e-commerce. Through the e-commerce system, it's sort of it's Taobao or it's Tmall platform. It's sort of a gateway into a whole entire ecosystem, providing your payment services, all the way to your entertainment option, and once user get trapped within this stuck within this ecosystem, it's very hard for you to get out of this system. So yes, the government regulation can come in to sort of hamper its growth, but it has a very strong circular growth trend backing the whole entire economy, and as a result, Alibaba will be able to tap on to sort of the growth nature of the China market moving ahead. And if China were to set to become the world's biggest economy in the next 5 to 6 years, Alibaba will be one of the forefront to actually capture that kind of growth rate. And so yes, I think talking about the regulation, I think back about 1 to 2 years ago when I was actually covering Tencent extensively, Tencent also faced a few regulation issues with regards to the violence in the computer games. But eventually, just maybe, although the stock price actually lingered for a while, after the regulation sort of fizzled out and the company start to make, I think, compromises with the government, and the government let a lot of this regulation sort of ease a lot of the regulation. The company start to thrive very strongly, and actually Tencent did very well as a result. So we expect, yes, right now they are on the news for the bad reason, but look out for next 2, 3, 5 years, and you will see Alibaba probably doubling in share price.
Yeah, I totally agree with what Ziyan and Jun mentioned. I think many people still quite worry about the situation this time around, and I believe that even if you worry about the so-called anti-monopoly investigations, you have to assign some weighting on different scenarios to look at the whole picture. Because to be frank, if we talk about the Chinese politics, it's very complicated, no way for us to have any insight to share. But I think the best case for Alibaba this time around will be just pay back the tax and also the fine, because you know that the tax department official also involved in the investigation this time around. So based on the history, you know, for sure there will be some related issue with the tax, or the amount normally will not be small. So you can expect that Alibaba next year earnings will be somewhat affected by this one-off factors, if there is any. But if money can solve the issue, I think just let it to solve. But more people worry if the Chinese regulators will ban Ant Financial to do the consumer credit related business, which means Huabei, Jiebei, this kind of consumer department business that will be significantly impact on the Ant Financial business growth engine. But since Alibaba only holds 33% of Ant Financial, and Ant Financial only contribute less than 50% of the total revenue. So the impact, I believe, that is still manageable. And based on the latest news, should not be that bad, because the CBRC may only request and financial to follow the traditional financial institution requirements like those MPA assessments. So shouldn't be that bad. But last but not least, people also worry if the anti-monopoly investigation is really a harsh one. So by looking at different business of Alibaba, there is only one segment to be called as monopoly, which is the Ali Cloud. So its shares of Ali Group revenues actually not so big, less than 10%, but it is really fast growing, and it is one of the biggest cloud service provider in the world and also largest in China. So if there's anything to touch on this area, for example, like government wants shares from it or split it from the Ali Group, that would be, I believe that would be the worst case scenario. But you can't invest into a stock and keep thinking about the worst case scenario. You should assign some possibility. Like if you believe that there's only 5% probability, then the rest of the 95% will be like what Dejun and Ziyan mentioned. Then I think overall expected return should still be okay.
Right. Okay, thank you, gentlemen. So I see that there are also a couple of questions regarding property and financials. So for these questions, we will be tackling them in other sessions over the next few days, so do stay tuned. And to wrap things up, I think we can safely say that digital technology, be it China or global, they have dramatically changed our lives. They have dramatically changed the way we consume information, goods, and services. So one of the key takeaways is that while valuations are stretched, the investors, those who wish to still gain exposure to this sector, may consider engaging in our RSP program for the time being. And should the opportunity present itself, you may switch to a lump sum investment to bring down your total weighted average cost. And with that, I've come to the end of today's Q&A session, and thank you so much for your participation.
Thank you, Ferlin and panelists, for the insightful discussion, and to our audiences. We'll now proceed to the daily quiz, where 3 winners with the most accurate and fastest answer will walk away with $100 worth of FSM1 multi-currency cash account credits. To access the quiz, you'll need to be on Event Live. Click on Event Activities on the black menu below the video window. Under the agenda, look for the quiz schedule. Click on Join Quiz, and the activity window will be displayed on your right. Once the quiz ends, a leaderboard will be displayed, and you may check if you're one of the winners. If at the end of the quiz, the results screen show rank 1, 2, or 3, it means you're the winner. Are you ready? Let's start the quiz now. Let's start with a warm-up question. What does WAWTI 2021 stand for? Option 1, What and Where to Invest 2021. Option 2, Wealth and Wit, the Insights for 2021. Or option 3, Wealthy and Woke to Invest 2021. Look around your screen and you'll see the answer. Yay, 97.8% of us got it right. So what and where to invest 2021? Now let's get ourselves ready for question 1. This question will count towards your final ranking, so please be ready. From a macro perspective, which market is FSM1.com most bullish on? Is it Singapore, Thailand, China, or the US? Think back to everything we've discussed today, which one do you think the correct answer is? Congratulations! 88% of us got it right. It's China. Oh, answers are still coming in. Here is the leaderboard. Check if your name is on it. Otherwise, it's okay. We have 4 more questions to go. Are you ready for question 2? Which of the following is not one of the 8 segments that make up the digital economy? Is it e-commerce? Cloud services? Is it fintech? Or home builders? Good job. Most of us got it right. It's home builders. Remember, 3 lucky winners are walking away with $100 worth of FSM1 multi-currency cash rewards. We have 3 more questions to go. Congratulations, PS. You're currently in rank 1. Oh no, you've been overtaken by JH Chia. Next up is question 3. Which of the following are some of the largest companies belonging to the digital economy from 2010 till date? Option 1, Apple and Microsoft. Option 2, Facebook and BHP. Option 3, Amazon and ExxonMobil. And option 4, Google and PetroChina. Correct answer is Apple and Microsoft. Good job to 94% of us. If you got that question wrong, do not worry. We have 2 more questions to go. 3 winners with the most accurate and fastest answers will walk away with $100 worth of FSM1 multi-currency cash account credits. I see Zaylene in the top 3 for the past few rounds. Good job. Question number 4. Which of the following does the Nikko AM ARC Disruptive Innovation Fund focus on? Is it watercrafts, boats, ships, hovercrafts, submarines? Is it FANGs, Facebook, Alphabet, Amazon, Netflix, Google? Is it DNA sequencing, blockchain, artificial intelligence, robotics, energy storage, or army equipment, ground vehicles, firearms, radars, and attire, etc.? Good job, it's DNA sequencing. If you were paying attention, you would have heard in the presentation earlier. Okay, we are cutting it close. Zaylene, you've dropped down to rank 4. What happened? It's okay, you have one more question to climb the ranks. Get yourself ready, it's the very last question. Which of the following global assets had the best performance in 2020? Option 1, World Growth Equities. Option 2, China A Equities. Option 3, US Equities. Or option 4, China IT Equities. Think hard on this one. It's the very, very last question. If you get it right, you may, woo, congratulations, it's China IT Equities. If you got this right, you might be one of our lucky winners. And here are our winners. Okay, do not exit your screen. If your results screen shows rank 1, 2, or 3, you must take a screenshot showing the whole activity window and ensure that your ranked score nickname are captured clearly. And then email the screenshot and also include your name, FSM account number, and the daily quiz date to events@funsupermart.com by 31st of January to claim your prize. That's all we have for today, but what and where to invest is not over. We have 4 more exciting days of more insightful presentations coming up on the 12th, 14th, 19th, and 21st, and a special Chinese-only presentation on the 26th of January from 7 p.m. to 9 p.m. in the evenings. Be sure to catch us as we discuss bonds versus bond funds versus bond ETFs. We'll also discuss ways you can protect your portfolio from black swan events and ways to keep your portfolio green. We asked the questions to the 5th person, should we go for growth or dividends in 2021? Chin Hui Leong from The Smart Investor will share some of his investing strategies and discuss if we can time the markets. We'll also have with us Timothy Ho from Dollars and Cents plus Dawn, the Budget Babe, and Kenneth Lowe from Sidley, who will be sharing on the 21st of January in a session dedicated to helping those who are new to investing get up to speed. There will also be 4 more days where each day we will be giving away $100 worth of FSM1 multi-currency cash account credits to 3 lucky winners on the daily quiz. So each day is a new opportunity for you to accumulate chances for the lucky draw happening on the 21st of January, where the lucky winner may stand to win up to $1,000 worth of FSM1 auto sweep account credits. It's goodbye for now, and don't forget to check out the rest of the promotions on fsm1.com has launched in this period. We hope to see you on the 12th of January at 7 p.m. Thank you and goodbye.